Good morning. As the Market Risk Advisory Committee alternate designated federal officer, it's my pleasure to call this meeting to order. Before we begin this morning's discussion, I would like to turn to the commissioners for opening remarks. We'll start with Commissioner Kristen Johnson, the sponsor of the Market Risk Advisory Committee, followed by Commissioner Mersinger. Commissioner Johnson.
Good morning. Thanks so much, Peter. I'm excited to welcome all of you to the third Market Risk Advisory Committee meeting for 2023. During the first quarter, the first week of March, in fact, we held a first of its kind convening in the wake of one of the most concerning cyber attacks in our markets in recent years. The entity at the center of the cyber incident, ION, is not a CFTC registered market participant. Rather, ION is a mission-critical third-party service provider. This incident and the discussions from the MRAC meeting held by former CFTC commissioners, White House executive experts, and the presidents and CEOs of the largest industry trade associations, as well as public interest and consumer advocates. In Q2, we led the advisory committee outlining work streams for several important subcommittees. And what I'd like to suggest is that we can already begin to see the fruit of our labor. This week, the CFTC will consider a proposed rule that addresses that very issue we launched the year, March 8th, 2023, thinking about. Today, we'll continue the long tradition of this committee's engagement with the Commission, and bringing valuable insights into the concerns that shape the stability and integrity of global derivatives markets. It's through this collaborative effort that we can influence industry standards, best practices, the agendas of this agency and others around the world, and provide thought leadership on the most important issues that impact citizens and businesses in every corner of the globe. Today, we have a pretty ambitious meeting planned. Our agenda will begin with presentations on 8 topics from 7 work streams currently operating in 2 of the MRAC subcommittees, CCP Risk and Governance and the Market Structure Subcommittee. Although the final 2 subcommittees, Climate-Related Market Risk and Future of Finance, will present at the end of the agenda, I think it's worth opening with a preview of the issues that these 2 subcommittees will begin to explore in 2024. Tomorrow will mark the conclusion of the 2023 United Nations Climate Change Conference known as COP28. Notwithstanding the dusting of snow here in Washington, D.C. this morning, cooling us off, it's clear that 2023 will end up being the hottest year on record. In fact, according to a recent report from the World Meteorological Society, the past 9 years since 2015 have been the warmest 9 years on record, with mean temperatures now 1.4 degrees Celsius above the average from the second half of the 19th century. Concentration of greenhouse gases are at record levels, and the ocean is heated to its highest level in a 65-year observational record. The Biden administration is taking steps to limit climate change. At COP28, Treasury announced a pledge of $3 billion to the Green Climate Fund, a UN-based design to help developing countries with adopting and mitigating climate change. The EPA announced a new rule. It's imperative that we here at the CFTC do our part. So in fact, last week, our chair announced, and I'm pleased to suggest that I supported, proposed guidance with respect to the listing of voluntary carbon credit derivatives contracts for designated contract markets. Later in our agenda, Tamika Bent, my chief counsel and designated federal officer for the MRAC, will describe the guidance as well as potential work streams that might grow for MRAC's climate-related market risk subcommittee. There are deep and persistent concerns regarding the integrity, credibility, and lack of visibility in the market for VCCs. I explained recently at a speech at the Dallas Federal Reserve Bank that we must address transparency, additionality, risk of reversal, robust quantification, governance, tracking and double counting, inspections and provisions, and sustainable development in these markets. I called on those of us who are willing to be part of a coalition of the willing, that is, market regulators and committed financial market participants. We can play a role in developing and implementing some basic foundational reforms. In addition to thinking about the role next year in 2024 that the climate-related market risks subcommittee might undertake, we'll also hear from, at the end of the program, a second subcommittee that will launch additional work streams. In London last week, I spoke at the Financial Times Crypto and Digital Assets Summit. In fact, there were members of the IMRAC here today who joined me for that program. I spoke about vertical integration, corporate governance, and risk management measures, as well as cyber risk and operational resilience. In discussing these topics, I'm hoping that one, I'm outlining potential work streams that the subcommittee might take up in 2024, as well as issues that the commission might begin a rulemaking process to address. Last fall, the Financial Stability Oversight Council called on regulatory agencies to thoroughly analyze the impact of vertical integration and determine whether it is a model that should be supported by existing laws. I look forward to hearing from IMRAC members later today as we discuss this very topic. Finally, I'd like to turn to our formal agenda for today because it too is very full. Today, we'll begin to explore over the course of several panels the work streams that have been undertaken by the CCP Risk and Governance Subcommittee and the Market Structure Subcommittees. These work streams are live, active, and producing potential recommendations as early as the first quarter 2024 for the Commission to undertake. Our agenda begins with a discussion that outlines several of the most critical issues facing global financial markets. In fact, we'll hear from one of the most influential thought leaders in this space, Christopher Hayward, Policy Chair for the City of London Corporation. After Chris's remarks, we'll hear from a panel of discussants, including Mr. Klaus Lober, Chair of the European Securities and Markets Authority CCP Supervisory Committee, and here at the CFTC, Richard Hayes, Deputy Director of the Risk Surveillance Branch in the Division of Clearing and Risk. Following the presentation by this panel, our subcommittee work streams will begin to present the issues that they're focused on. Our work streams include technology and operations, resolution and recovery, margin and collateral. Following the presentations by the CCP Risk and Governance Subcommittee, we'll hear presentations from the Market Structure Subcommittee work streams. The Market Structure Subcommittee work streams are include a number of thought leaders who are easily introducing issues that are at the fore of our thinking here at the Commission and for regulators around the world. We'll begin with a presentation by Ashwini Pants, Head of Risk Oversight for ICE Clear Netherlands and Chief Risk Officer for the North American Clearing Houses. She'll present on the results of the workstreams analysis for FCM data and preliminary conclusions on FCM capacity and concentration. Following this presentation, Co-Chair Ann Battle will provide an update on the workstream's plan to study and prepare potential recommendations related to the U.S. Treasury basis trade. Joining Ann for this discussion is Jennifer Hahn, Chief Counsel and Head of Global Regulatory Affairs at MFA, and in addition, Sam Schulhofer-Wall, Senior Vice President and Senior Advisor to the President of the Dallas Federal Reserve Bank. Co-Chair Battle will also give an update on the block workstream, focusing on preliminary feedback on a request for analysis on block market participants prepared by the workstream. Finally, for this panel, we'll hear a presentation on the post-trade risk reduction workstream. I'm looking forward to hearing from all of our members who've been working tremendously hard to advance these issues. I'm grateful in advance to the hard work of the ADFO and DFO for IMRAC, who are my Chief Counsel and Senior Counsel here at the CFTC. And in addition to their support, our chair, of course, Alicia Crichton, who also serves as chair of the FIA board. I'm thankful for my fellow commissioners who have been able to join and would like to express in advance and in detail later tremendous thanks to the other DFOs, Daniel O'Connell and Parisa Nuri, as well as all of those who support the creation and facilitation of today's meeting. Thanks so much. I'll pause there.
Thank you, Commissioner Johnson. Now we'll hear opening remarks from Commissioner Mersinger.
Good morning, everyone, and thank you for being here and fighting the snow to get in. I was not prepared to scrape off my car this morning, so I'm just happy I made it in time. I'm going to keep my remarks short because we do have an aggressive agenda, but all of the topics are so important right now, and they are subjects that we are grappling with at this very moment. So I'm very glad that we are having these discussions. Thank you to Commissioner Johnson for having this meeting and bringing these topics to the forefront. Very interested to hear about block trade implementations and any concerns that stakeholders have about the current calculations and how that will impact their businesses. Treasury market reform, CC risk and governance, all of these are important topics. FCM capacity, very happy to see that that's on the agenda because that has been a topic that I think has not gotten enough attention lately, but it's certainly something we need to be focused on. So I'm just excited to hear from everyone today. Thank you all for being here. And with that, I'll just turn it back over to Peter.
Thank you very much, Commissioner Mersinger. Before starting our discussion, there's just a few logistical items I've been asked to mention to the committee members. Please make sure that your microphone is on when you speak. This meeting is being simultaneously webcast, and it's important that your microphone's on so that the webcast audience can hear you. If you'd like to be recognized during the discussion, please change the position of your place card so that it sits vertically on the table, or raise your hand and Chair Crichton will recognize you and give you the floor. If you're participating virtually and would like to be recognized during the discussion for a question or comment or need technical assistance, please message me within the Zoom chat. I will alert Chair Crichton that you would like to speak. Please identify yourself before you begin speaking and signal when you are done speaking. Please speak directly into your microphone for optimal audio quality on the webcast. Please unmute your Zoom video before you speak and mute after you speak. Please only turn on your camera when you're engaging in discussion. And if you're disconnected from Zoom, please close your browser and enter Zoom again using the link previously provided for today's meeting. Before we begin, we'd like to do a roll call of the members participating virtually, so we have your attendance on the record. After I say your name, please indicate that you are present and then mute your line. Robert Allen.
Present.
Ruth Arnold. Richard Berner. David Bowman.
Present.
Neil Constable. Edward Dasso.
Present.
Gina Gale Fletcher.
Present.
Joseph Garelick. Lindsay Hopkins. Dimitri Carusos.
Present.
Derek Kleinbauer.
Present.
Tim McHenry.
Present.
Jonathan Levin.
Present.
Craig Messinger.
Present.
Rajalakshmi Ramanath.
Present.
Guy Rowcliffe. Suzanne Sprague. Victor Vadas.
Present.
Present.
Kevin Werbach. Nathaniel Werfel.
Present.
And Juan Zhang. Thank you all. We'll now hear from Chair of MRAC, Alicia Crichton.
Good morning. Nice to see you all. Today, as Commissioner Johnson indicated, we will engage in discussions involving CCP risk and governance, market structure developments, climate-related market risks, as well as host a discussion of issues surrounding the introduction of several emerging technologies and the development of the carbon credit market. Our first series of panels today will present the work streams of the CCP Risk and Governance Subcommittee. For our first panel, Christopher Hayward, Policy Chairman of the City of London Corporation, Klaus Lober, Chair of the CCP Supervisory Committee of the European Securities and Markets Authority, and Richard Haynes of the CFTC Division of Clearing and Risk will offer a macroeconomic view of issues that are in the spotlight for US regulators and their counterparts in a number of jurisdictions, as well as multinational market participants in the clearing markets. With that, we'll start with section 1 and the opening remarks of CCP risk and governance.
It is a pleasure to address the CFTC's Market Risk Advisory Committee. I'm sorry that I can't be with you all in person. I have missed you all by a day as I am currently in New York and will only be travelling to DC tomorrow. I'm particularly disappointed to have missed you, given that this is a big moment for the City of London Corporation. As many of you will know, we act as a representative of the United Kingdom's financial and professional services sector, an industry that has evolved over the centuries, but one that we are proud still calls the square mile home. But we see the FPS sector as much more than a national asset. Indeed, given the global nature of FPS provision and value that worldwide FS delivers as an engine of prosperity, we see the sector as very much an international one. As a statement to this effect, this week we are announcing the establishment of the City of London Corporation's first ever US presence. Our objective is to support US-UK collaboration across the policy waterfront to both deepen the FPS corridor where possible and promote alignment in our approaches to shared challenges. In these difficult macroeconomic and geopolitical times, this has to be right. I will be in Washington tomorrow introducing our excellent new Managing Director, Ed Price, to the DC policy community, and I hope all of you will have the opportunity to meet him very soon. One of our core objectives is to ensure US-UK alignment in some of the major forward-looking areas of regulation. An area that is front of mind in the UK and for Commissioner Johnson is crypto assets. The UK government and regulators are thinking deeply about our approach to this area and is positioning the UK as an honest broker, not necessarily at the leading edge, but not leaving a vacuum in this innovative area either. The UK Financial Services and Markets Act, concluded this summer, gives regulators the powers to take positive steps. His Majesty's Treasury confirmed plans last month to put in place a regulatory framework for fiat-backed stablecoins. We are helping regulators think this through and will be responding to the open discussion paper, underlining, among other things, that same risk, same regulatory outcome should be an underlying principle. We are also engaging in the proposals to develop the UK's first ever digital securities sandbox to facilitate the testing and adoption of securities across financial markets. We see this as an encouraging development, and we think one area where the US and UK collaboration may bring benefits. We see opportunities in the US and UK exploring how cross-border or multi-jurisdictional sandboxes could help develop interoperable regulatory approaches in response to emerging technologies and potentially authorization in multiple jurisdictions. One of the many conversations that we hope our new office may facilitate in the near future. I wish you all well.
Hello, I'm Klaus Löber, the chair of the CCP Supervisory Committee within ESMA, the European Securities and Markets Authority, and I'm grateful for Commissioner Johnson to have invited me to join this Market Risk Advisory Committee meeting. Unfortunately, I'm unable to join you in person, but I'm very happy to share some thoughts with you and to provide also a bit of background on the Supervisory Committee and its activities. The CCP Supervisory Committee was established in January 2020 as part of a review of the legal framework supporting European market infrastructures, which is shortly known as EMIR, the legislation governing the central clearing of derivatives, but also the requirements of supporting market infrastructure, including central counterparties in the EU. The review of EMIR actually was focusing on two main pillars. First, to enhance the mission of promoting supervisory convergence amongst EU CCPs. For example, via validations, opinions, and recommendations directed at the national authorities, but also addressing the risks linked to EU counterparty exposures to third country CCPs. As such, the CCPRC covers 14, soon 15 EU CCPs and 38 third country CCPs based in 21 foreign jurisdictions. 2 out of those 38 third country CCPs are considered of systemic importance to the EU financial stability and are thus directly supervised by ESMA These are 2 CCPs located in the United Kingdom. The CCPSC is quite an original EU setup, which is subject to decision-making processes being responsible to the ESMA Board of Supervisors, but also to the European Parliament. The composition entails representatives from 12 national supervisors of EU CCPs, but also 4 central banks of issue of the major currencies inside the European Union and 2 independent members, plus myself as a chair. It's a quite unique setup that can leverage on the expertise of the national competent authorities, but also the team built up in ESMA, and can thus develop a risk-based supervisory perspective that can cover multiple CCPs and has a perspective on ongoing and emerging risks. For the tools that we use to set our regulatory and supervisory priorities, we have an annual heat map where ESMA identifies the most prevailing risks per sector. For CCPs, this means that we discuss amongst the supervisors the key risks which are likely to shape the CCP space, both in terms of impact and likelihood. As part of our 2024 heat map, ESMA identified and prioritized a number of risks for its convergence and supervisory activities. Compared to last year, we have actually 3 types of risk: operational risk, procyclicality, and market risk, here in particular commodities and interest rates, which remain at an all-time high, given the persisting geopolitical tensions and the requirements, the developments evidenced by market data. Concentration risk also remains at a high scale within our risks. Here, for example, the nickel event at the LME has served as a reminder of the challenges in appropriately managing concentration risks. As a result of this year's recalibration, and following some observations we have made across CCPs, ESMA has increased the risk related to governance and controls to medium-high, whilst the risk related to recovery plans, which formerly was considered at a higher scale, has been reclassified as medium, given the progress made in the EU following the implementation of the CCP Recovery and Resolution Regulation and the development of recovery plans across EU CCPs. A new addition on the risk side is the investment risk, which has come to the forefront following the experiences with the LDI stress events last year and has been categorized as medium next to risk coming from financial innovation. I should also mention, for completeness, that we also consider a number of risks as inherent, namely membership due diligence, interdependencies, default management, and liquidity risk, in relation to which no additional supervisory work is envisaged beyond the ongoing monitoring activities already conducted. Based on this identification and prioritization, we are conducting at ESMA a number of activities, and I want to share with you some of those in terms of trying to mitigate the potential impact of those risks. As regards the high category risks, for operational, particularly cyber risk, in the EU, we have recently adopted the Digital Operational Resilience Act, which is also called DORA, which covers both cyber, but also ICT risk in CCPs, and also other supervised entities, but also the risk coming from third parties through outsourcing or different service provisions, such as coming from the provision of cloud services, DLT, or more recently, AI service providers. DORA has entered in force in January this year and will apply as of 2025. And we have quite significant efforts to conclude the detailed technical standards and to make it operational within the timeframes foreseen by the law. We also published last year the results of our 4th EU-wide CCP stress testing exercise, which included for the first time operational risk elements, focusing in particular on the increasing reliance of CCPs on shared third-party providers. We are currently following up on the findings of this stress test and aim to see how the framework could be improved for future iterations here. We are also heavily invested in the work at the international level within the Operational Resilience Group, recently established by CPMI OSCO, which I have the pleasure to co-chair, which is covering these aspects, looking at whether the existing international standards in that field for FMIs are sufficiently granular and calibrated in view of these types of risks. Concerning procyclicality, we have observed in the significant stress events over the past 2 years that there are certain issues which may require a bit of calibration, in particular as clearing members exposed to high margin calls will in turn require additional margin from their clients, adding to liquidity strains in the wider clearing ecosystem. This, in the view of ESMA, calls for additional transparency at the level of the CCP, but also at the level of those clearing members providing client clearing services. We were very much looking forward to the publication by the end of the year of the joint Basel Committee CPMI-OSCO report on the review of margining practices. And we hope that together with our international colleagues, including the CFTC, we can turn this into meaningful guidance to mitigate the spread of liquidity risk across parts of the financial system. When looking at the other risks, very shortly, the CCP Supervisory Committee has planned for next year a peer review on governance and controls in relation to outsourcing of critical operational functions, but also intergroup governance arrangements, including internal controls functions such as internal audit. For concentration risk, we are following up on the findings of the last stress test, and we will look into whether there is a need for future adaptations of CCP risk models linked to concentration risk, which will also focus in our next stress test exercise that we have just launched. Lastly, and focusing on the planned peer review for next year, we are looking at convergence issues regarding the implementation of new regulatory requirements like investment risks that have been integrated as well in next year's stress test exercise. So let me conclude with a quick look at the new risks that we have identified in relation to financial innovation. Here, the CCP Supervisory Committee will continue monitoring issues resulting from CCPs using new technologies, but also engaging activities related to crypto asset related products or alterations of their clearing models. I hope this provides you with an overview of what ESMA is conducting in terms of its identified priorities in terms of risks across the CCP sector. And I wish you a very fruitful discussion, and I very much hope that I will be able to engage with you in personal discussions at a future opportunity. Thank you very much.
Okay. Hopefully people can hear me. Although I do hear a little bit of an echo. Maybe that's me. I don't know. We'll see. So thank you very much. First, I want to thank Commissioner Johnson, Commissioner Mercinger, Alicia, Peter, and the members of MRAC for the opportunity to briefly discuss a few topics related to cleared markets. Before that, though, I do want to note that my remarks are my own and don't represent those of the CFTC or anyone else at the Commission. So I'm going to dig just a little bit more into actually one of the topics that Klaus mentioned close to the end of his presentation on transparency. But before that, it may be useful to give a short overview of my own team. The Risk Surveillance Branch at the CFTC, RSB, our acronym, is one of the what I will call quantitative arms of the agency with a number of analytical responsibilities. Reviewing new and amended DCO margin and risk models, monitoring risk and positions on a daily basis in all cleared derivatives markets, leading or co-leading FCM and SD reviews, and engaging in longer term and more detailed quantitative analysis like our supervisory stress tests. Very similar to the supervisory stress test that Klaus also just mentioned. To put it perhaps a little too glibly, if it is a number or equation associated with cleared derivatives markets, guess what? We make sure we understand it. So not surprisingly, this has led us to develop a myriad, 10, 20, of dashboards, automated alerts, and regular reports to better understand the links between key market participants and how these links may be affected by unanticipated and extreme market stress. So to shine some additional light on our work, I will turn to perhaps an obvious theme: stress events in recent years. COVID, the invasion of Ukraine, LME, I could continue. Events like these have given us a much clearer understanding of how CCPs and participants react to an increased need for, and often an increased cost of, liquidity. And as importantly, maybe more importantly, they demonstrate how these reactions can differ across markets and entities. Now, public reviews of both early COVID and early invasion periods speak to these differences, whether we focus on funding sources, collateral types, or exposure profiles within our markets. So because of this, paired with the quantitative analysis in the reports, were 6 related policy themes. 2 of these 6 were potential additional transparency efforts, there's that word, and potential additional analysis of the size and nature of liquidity demands. Further work in these areas has continued to seek areas where, for instance, more information about potential future liquidity demands and the speed of those demands could aid stress preparations and mitigate any frictions that could occur. This work may be especially important for end users, very common in our markets, who often have fewer and more indirect ways to access liquidity pools. And we saw in 2022, again, another recent event, parts of Europe establishing liquidity facilities to aid end user liquidity needs during periods when pressures were unusually high. I think makes sense. So I'll pair these brief thoughts on market transparency with a few on transparency to regulators, to us. I mentioned our dashboards and our reports, which rely on the detailed data we gather daily, mostly daily, sometimes weekly, sometimes monthly. It is primarily through these that we are able to highlight areas of concern, such as unexpected market exposures, where we need to seek more information from CCPs or members. And this can often lead to calls or other discussions to ensure that, hey, we fully understand those positions and how they would behave in calm and extreme markets. It goes back to, we need to understand every number and every equation. We are able to do this because of the feedback loop between our data and analysis. And in fact, just this year, we updated and expanded the data we collect in the light of analysis that we wanted to do, but that required some data refinement. So my discussion of transparency as one last branch that I'd like to mention before closing. A number of our clearinghouses in recent years have made significant updates to their margin models in cases shifting from what I will admittedly too simply describe as product level to portfolio level views. I welcome these changes and the robustness and sophistication of these models, and I anticipate that they will serve us well in future stress events, perhaps similar to ones we've had, perhaps very different from ones we've had. But there is often an inherent and necessary complexity to these new models, and we want to make sure that inherent model sophistication is paired with a full understanding about what this means for behavior during stress periods, not just for the base model, but for other things, again, like Klaus mentioned, for instance, liquidation and concentration costs or concentration add-ons. So we again come to the question about market and regulator transparency and what this may mean for individual asset classes or participant groups. Unfortunately, and partly I'm looking at the clock, so perhaps fortunately, I may be disappointing you by not going into further detail here, but I do want to emphasize that this is a theme we have given much thought to in the light of the events I have noted. So I will close with a nod to the others on the panel, my esteemed colleagues from around the world. The CFTC has a deep view into many markets and many entities. I've talked about our data briefly, admittedly. But we still see only a part of the derivatives landscape. The others on the panel have views that overlap in part, but also extend far beyond. And so we speak regularly with peers, including ESMA and other international organizations, to share what we can of our own perspectives. So I want to thank those peers for that collaboration and return to the panel title of International Perspectives. It is through conversations such as these, such as those, that we can gain the knowledge needed to view the market from a truly international perspective. So thank you, and I will pass it back to the moderators.
Great. Thank you very much, Chris, Klaus, and Richard. We'll now turn to the second work stream of the CCP Risk and Governance Subcommittee. We'll now hear from Lee Betzel, Managing Director and Chief Risk Officer of the CME Group. Lee?
Thank you. Thank you, Chair Crichton, Commissioner Johnson, and all at the CFTC for supporting the pressing agenda facing the Commission. Our technology and operations workstream also appreciates the contributions from our expert guests and continued interest from many thoughtful and concerned parties within the financial services ecosystem. The technology and operations workstream composition includes Chris Edmonds, who is the subcommittee co-lead and workstream chair for this workstream, Timothy McHenry from the NFA, representing the regulator view, Dick Berner from New York University, representing an academia view, Graham Harper from DRW, representing a client view, and myself. The workstream is proud to offer updates on two important topics during today's meeting. The first will cover the use of legal entity identifiers, followed by a progress update on mission-critical third-party vendors. So, during the financial crisis of 2008 and 2009, global regulators desired to better understand sources of risk and prioritize these efforts while developing new financial reforms. The European Union adopted the use of legal entity identifiers, or LEIs, and mandated that LEIs be reported during order entry. During the debates surrounding the Dodd-Frank Act, the idea of mandating the use of LEIs was deemed potentially too expensive or operationally burdensome, as the complete impact of implementing a new requirement was unknown. The EMIR legislation in the European Union followed the implementation of the Dodd-Frank Act and provided the additional time needed to better assess the impact on market participants. Typically, LEIs are assigned by the GLIEF organization and are only available for corporate accounts. While there is a segment of the domestic trading community not eligible to obtain an LEI, the total risk of these accounts represents less than 5% of outstanding risk, as measured by the collateral on deposit at CME and at ICE. So the workstream discussed the industry response to the ION cyber incident and determined that account recovery and the resumption of reporting could be greatly enhanced if the reconciliation process becomes more efficient. The ability to assign the risk to the beneficial account owner is increased with the use of LEIs. While this path does not represent a 100% solution, the workstream agreed it is beneficial for the industry to move forward with implementing LEIs at the account level. For such reason, the workstream encourages the full MRAC to recommend a proposed amendment to 39.19 ia to increase the enforceability and usage of illegal entity identifiers by requiring all eligible entities defined as a beneficial account owner to obtain an LEI and to report such identifier to their clearing member. I'll pause there. Alicia, back to you.
Great. Thanks, Lee. We'll now open the floor for member discussion. Okay. For our second work stream on third-party risk, we'll first hear from Lee Betzel. Then we'll hear a presentation from Julie Moore, Deputy Director of the CFTC's Division of Clearing and Risk. And finally, we'll hear from Don Byron, SVP and Head of Global Industry Operations and Execution at the Futures Industry Association. And back to you, Lee.
Thank you. So the next topic reviewed by the Technology and Operations Workstream, Mission Critical Third-Party Vendors, the Workstream members appreciate the limited visibility the Commission and its staff have into the vast use of service providers by CFTC registrants. The workstream values and seeks to promote the innovation efforts represented by a growing ecosystem of third-party vendors. While the CFTC cannot regulate all direct and indirect operational functions of registrants, it can develop clear definitions and guidelines consistent with its regulations, the Commodity Exchange Act, and relevant U.S. law. There are several U.S. and global regulatory agencies and cross-border efforts seeking to find the right balance of operational oversight and corporate freedom to pursue such innovation. The workstream has developed an inventory covering many of these efforts and reviewed work by trade associations that have published thoughtful work on this topic. Our review of these efforts continues, supplemented by input from market participants and members of the workstream to understand the impact and practical application of such oversight. We will continue our efforts in the coming months with a desire to drive consensus and to report back during the next full MRAC meeting our findings, and where appropriate, recommendations for the MRAC Commission staff and commissioners to consider. Thank you.
Great, thanks, Lee. And next we'll hear from Julie. Okay. Don, we're actually going to start with you, and then we'll try and circle back to Julie with some audio problems.
Okay, great. Thank you. Thank you, Chair Crichton, Commissioner Johnson, fellow commissioners, and the MRAC. It's an honor to be invited to speak with you today on such an important matter. And at the March 2023 MRAC meeting, FI President and CEO Walt Lukin spoke on the importance of strengthening resilience in the global exchange-traded derivatives markets. This came off the back of a ransomware attack on a single service, third-party service provider at the end of January. The ION attack significantly impacted the processing of trades executed on multiple exchanges and CCPs globally, and demonstrated that this type of attack can be particularly disruptive in a highly interconnected ecosystem such as ours. In his remarks, Walt announced the formation of a global FIA cyber risk task force to review the event and develop recommendations for improving the resiliency of our markets. The industry task force consisted of a cross-section of subject matter experts and business leaders within the exchange-traded derivatives and cleared industry, including exchanges, CCPs, clearing firms, third-party vendors, end users, and other financial sector partners. In September 2023, FIA released an after-actions findings report that outlined lessons learned from the event, including 6 recommendations and findings from the task force for improving the industry's ability to withstand future attacks and outages. Among some of the report highlights, I'd like to now outline some of the recommendations and findings in the report. The report identifies the disruptive impacts of a cyber incident, specifically response, which is coping with the immediate breach of an impact. Second is recovery, which is rebuilding and restoring systems and databases. Third is reconnection, which is the reconnection to market infrastructures, service providers, and other organizations. The report highlights that exchanges and CCPs play a critical role in the front-to-back trading and clearing ecosystem of the industry. From an operations and technology perspective, they provide their customers with data and information that is required for, among other things, trade processing, clearing, risk management, and other critical functions. Therefore, exchanges and CCPs are essential when dealing with the disruptive impacts of any outage that affects our ecosystem, and including most cases working with third-party service providers. That being said, the related recommendations were not limited to exchanges and CCPs. Instead, the task force found that they should focus on all market participants, market infrastructures, and third-party service providers within our industry. Next, I'd just like to provide a brief overview of some of the recommendations outlined in the paper, starting with the industry alignment with existing reconnection guidelines. The attack demonstrated that the complexities of rebuilding impacted systems and restoring normal service through industry participants required intensive work to gather and process missing trade records and to reconnect systems to the rest of the marketplace. Several financial sector groups have developed guidance and frameworks and tools to guide firms through the process of reconnecting in the aftermath of a cyber incident. These include CMORG in the UK and the Financial Service Sector Coordinating Council in the US. The task force recommends a review of these connection guidelines, which could help facilitate a more efficient and recovery process for the industry. Therefore, these guidelines should be promoted, reviewed, and practiced through industry forums, including through FIA. Next, the next recommendation I'd like to highlight is supporting the sharing of information with connected parties regarding contingency plans in the event of a cyber incident or other type of outage. To optimize the success and timeliness of a market recovery after an incident, market participants need to have an ex-ante understanding of the reconnection contingency plans of various market participants and third-party service providers. The task force encourages to establish procedures for sharing critical data and other information with their counterparties and clients in a timely manner during a cyber incident. Having a clear understanding of those procedures ahead of an incident can streamline information sharing during an incident and accelerate the recovery process. Next, improving the risk assessment of third-party service providers. As Lee had mentioned, many participants in the global exchange industry rely on these third parties for essential services to their participation in the markets across the industry's ecosystem. Rather than one set of risk management practices that apply to all third-party service providers and market participants equally, the policy should allow for risk management practices to be calibrated to such factors as the type of service that is provided, the nature of the relationship, and the potential impact of disruption to that service. And then lastly, a few other recommendations that I'd like to discuss from the task force. One is the FIA formation of an industry resilience committee as a standing industry-wide group that serves as a trusted forum for key stakeholders to discuss cyber incident management and resilience planning, and also recommend best practices for the industry. The recent cyber incidents also showed that FIA itself has an important role in industry communications. This includes not only functioning as an information clearinghouse during an incident, but also encouraging preparedness across the industry. We've also outlined to engage with sector-wide groups on cyber and operational resilience through the work of FIA. This includes such organizations as the Financial Services Coordinating Council, or FISC, and the Securities Industry and Financial Markets Association, SIFMA, which we did during the recent ICB Financial Services cyber incident. Lastly, the final recommendation is for the participation of the industry in regular cyber preparedness exercises. These exercises include the Hamilton exercises organized by the U.S. Treasury Department and the Quantum Dawn exercises organized by SIFMA. The task force recommends that these exercises should incorporate scenarios related to exchange-traded and cleared derivatives markets. And lastly, I'd like to conclude and just say FIA is committed to working with the broader industry to ensure our markets are resilient against cyber threats and other types of outages. Thank you again for the invitation to speak today on this important matter.
Thanks, Don. And now we'll hear from Julie.
All right, just test to make sure that you can hear me. Okay. Thank you, Commissioner Johnson, for giving me the opportunity to speak today. I am Julie Moore. I manage the CFTC's examination program for derivative clearing organizations, otherwise known as DCOs. I will take the next 5 minutes to give an overview of the regulations that pertain to the responsibilities of a DCO that outsources clearing responsibilities to third parties and DCR's examination program on this topic. However, the views that I am about to express are my views, and they do not necessarily reflect the views of the Commission or the Chairman. Let's start with the regulations, in particular 3918D. It states that the DCO can outsource its responsibilities for its program of risk analysis and oversight with respect to operations and automated services. But if it does this, the DCO, and I will quote the regulation here, retains the complete responsibility for any failure to meet the regulations. And the regulation also states, again, I quote, the DCO must employ personnel with the expertise necessary to enable it to supervise the service provider's delivery of service. This means the DCO must perform due diligence to make sure, one, it understands how the third party will deliver the services. Two, how the third party meets minimum information security standards of the DCO. And three, how the third party will meet the standards of the regulation before it enters into a written contractual arrangement with the third party. The regulations also state that the program of risk analysis and oversight must be developed using generally accepted standards and industry best practices such as NIST. DCR has a program that it follows during the examination of third parties that are using that the DCOs use to complete clearing responsibilities. We are looking for the DCO to know its vendor. I will discuss some of the topics that we may look at during an examination. One, does the DCO have and perform due diligence procedures before entering into a contract with the vendor? Does the DCO look at things like reports, like maybe a SOC report, to gain some insight into the vendor's cybersecurity policies and procedures? And does the DCO ensure minimum cybersecurity standards of the third party that are similar to its own? Does the DCO have procedures that rank the third parties in terms of criticality of the services that the third party will provide? If the service provider is a critical third party, does the DCO perform due diligence activities at the third party on a more frequent basis? Another topic is the cadence of continued assessments and monitoring of the third party, and the governance process surrounding the third parties, who is responsible for reviewing to ensure that the third party risk assessments are being completed and that risks are being reviewed and identified. And lastly, how does the DCO monitor third parties that are completing work within its environment? For example, how are events identified and monitored within the SIEM and fed into the DCO cyber defense processes and procedures? So these are just a few of the components of our examination program on third parties. Some third parties potentially play very critical functions for some DCOs, such as data center providers or cloud service providers. It is important that the third parties do not bring a large amount of unmitigated risks to the DCO. To this end, DCR examines the processes and programs of the DCO to ensure third-party risk is, one, self-identified, regularly monitored, and governed by the same principles that apply to services produced in-house. Thank you.
Great. Thanks, Julie. And thanks to our panelists, Lee, Julie, and Don. We'll now open the floor for member discussion. Okay. We'll now turn to the third panel of this section, Recovery and Resilience. First, we'll hear from Alessandra Coco, currently on detail as Senior Policy Advisor at the Department of Treasury. Next, we'll hear from Juan Blackwell, Head of Credit and Counterparty Risk Management for the Ontario Teachers Pension Plan. Finally, we'll hear from Bob Wasserman, Chief Counsel of the CFTC's Division of Clearing and Risk. I'll turn it over to you, Alessandra.
Thank you. Thank you, Commissioner Johnson, Commissioner Merzinger, Chair Crichton, and CFTC staff for supporting the important work of the Commission in this area. And thank you to MRAC members and guests for being here today. We would like to acknowledge the work of the full membership of the work stream. The other members of the work stream are Ruth Arnold from B of A, Richard Berner from NYU Stern, Lee Betzel from CME, Reggie Griffith from Louis Dreyfus, Paolo Saguato from George Mason University, and Dimitri Caroussos from Nodal. I'd like to mention that my remarks are my own and don't represent the views of the U.S. Treasury. So first, we'd like, looking at the first slide 3, to provide a progress update. Members of the Recovery and Resolution work stream plan on issuing a report by the spring of 2024. Today, we'd like to cover some of the key issues that we plan on addressing in the report. We would also like to invite questions and comments on these topics. And I'm looking at slide 14. There it is. In the context of the work leading to the report, we plan to consider public comments received by the CFTC on the proposed rulemaking on DCO recovery and orderly wind down plans, as well as international developments such as the EU regulations and the FSB financial resources and tools for central counterparty resolution consultation report. So moving over to the next slide, the work stream's first consideration is that as we think of an effective recovery and resolution regime, the first line of defense is the resilience of DCOs, FCMs, and clients. Regulations requiring the implementation of recovery tools decrease the likelihood that resolution will be required. The regulations require CITCOs and Subpart C DCOs to have rules in place to allocate losses and restore the match book. Clearinghouses are a prime example of the interconnectedness of contemporary financial systems, where the connections between participants in financial markets can lead to greater efficiencies, but also to the potential for risks to spread more broadly and faster within the global financial system, revealing dependencies that may not be immediately apparent once critical risk thresholds are reached. So it's important to take into consideration the resilience of the whole clearing ecosystem. CCPs are designed to manage risks, but those risks are mutualized among clearing members. And so CCPs rely to a great extent on the ability of clearing members to absorb such risks by providing funded resources and unfunded commitments. Clearing members in turn rely on the ability of clients to meet their financial obligations with respect to clear contracts. So the ability of a DCO to recover from losses depends on that DCO's risk management, but also on the ability of FCMs and on FCM's clients to recover losses if needed. So turning over to the next slide, it's important to notice that the choice of recovery tools has policy implications. We know that CCPs operate based on the principle of risk mutualization, and CCP shareholders have exposure through skin in the game, tranches in the CCP default waterfall. On this point, in July 2021, the CCP Risk and Governance Subcommittee of MRAC published a report on DCO capital and skin in the game. So setting aside losses absorbed by any skin in the game tranches provided by the CCP, if the financial resources provided by the defaulter are insufficient to absorb losses, the loss is mutualized through the guarantee fund, but additional funds may be required to fully absorb the losses. And this is an important policy decision that determines who bears the immediate result of any losses in excess of the financial resources available to the CCP. So looking at the next slide, another factor to consider in the assessment of CCP recovery tools is liquidity. The ability of a CCP to recover from a default scenario from large non-default losses will be heavily dependent on what supply and demand looks like in terms of liquidity. We plan on taking into account different types of liquidity, so market liquidity and funding liquidity. Market liquidity is a measure of the ability of the CCP to turn an asset into a means of payment. Less liquid assets are those that are more costly to be converted into money. And some of the factors that impact this assessment are the speed and size of the transaction, along with the price impact of converting the asset into money. On the other hand, funding liquidity is the ability to borrow to fund assets held on balance sheet. The analysis of liquidity will depend on the products cleared at the CCP and the risk management tools used by the CCP. For a derivative CCP, market liquidity can be defined as the ease in which, following a default, the CCP can close an open position. And liquidity can therefore be measured by the bid and ask spread needed to transact, which typically increases during times of uncertainty. The analysis would be different for a repo CCP. A repo CCP would need to have appropriate liquidity instruments in place for non-cash collateral held as IM by the defaulting clearing member. And with that, I hand it over to Juan Blackwell for the remainder of today's presentation.
Thank you, Alessandro. Thank you, Commissioner Johnson, Commissioner Mersinger, and Alicia for allowing me to speak here today. I just want to reiterate Alessandro's point on clearing of cash securities. If a CCP enters into recovery or, God forbid, resolution of a cash security clearing mechanism, the amount of liquidity required could
enter into a doom loop, meaning that if you are clearing any cash security, particularly for funding purposes, you will end up in a situation where the market might be betting against the ability to continue down that path. So the CCP in question needs undoubted liquidity in order to ensure they can buy the other side. In cash security markets, the CCP no longer has what it needs to settle the trade. So I think that is a very important point for MRAC. I should have started with these comments are my own and not those of Ontario Teachers Pension Plan. With that, we'll move on to the next slide, please. International harmonization for large organizations and those that need to hedge in multiple markets is absolutely critical. It's necessary to be able to replicate the risks that we take across markets in order to ensure our end users have access to hedging tools for the assets that we need in order to, in my particular place, ensure that pensioners actually have funding for their own retirements in the future. Without international harmonization, it becomes more and more difficult to replicate those models across jurisdictions. However, there is one area where the working group will look at harmonization to a point. I am definitely not a lawyer, but you should not get to the point where you try and enforce harmonization where it is no longer applicable due to the legal jurisdiction or the bankruptcy laws in place wherever the CCP is headquartered. With that, we'll move on to transparency. Before diving in, I'd like to acknowledge the work that has been going on between FIA, SIFMA, and CCP Global since approximately 2021. I'd say some of this started in 2019 with a letter that a lot of end users signed and was circulated across the global community in order to ensure that there is transparency first for liquidity models. Most end users that have any sizable position try and replicate their own liquidity of that position to ensure that they can actually close out the position or maintain the position if markets become volatile. Without sufficient transparency, it becomes very, very difficult to do that. It's a guessing game, or worse, you end up being very, very conservative and not deploying capital in its most efficient form. Without transparency, you also cannot justify taking risk in some areas of the world. So this is where more transparency across CCPs, sharing of knowledge is actually a betterment of the financial system for stability. With that, I think we can hand it over to closing remarks and questions. Thank you.
Thanks, Juan. Bob, over to you.
Thank you very much. Thank you, Commissioner Johnson, Commissioner Mersinger, and Chair Crichton. First, I will note that the remarks I'm about to give do not necessarily represent those of the Commission or the staff, or even myself if I'm directed to change them. I'm going to discuss two things. First, the FSB's consultation on CCP resources for resolution and the comments on that consultation. And second, the Commission's proposed rulemaking for DCO recovery and orderly wind down. So FSB issued the consultation in September and comments were due on November 20th. The main point of the consultation is that resolution authorities for systemically important CCPs should have access to a set of resolution-specific resources and tools that meet certain dimensions. And they should be chosen from a set that includes bail-in bonds, equity, resolution cash calls, and variation margin gains haircutting. There were 10 comments from industry participants, including 8 from the CCP side and 2 from the market participant side, 1 from ISDA, FIA-IIF, and 1 from ICI, as well as a few others. While the industry participants took positions that broadly reflected their relative contrasting perspectives, there were a number of broad common points of agreement, one of which is the importance of flexibility in implementing resolution and of looking holistically across recovery through resolution. There was also broad agreement that further quantitative analysis is necessary. I would note that in 2022, FSB and CPMI-IOSCO undertook a quantitative analysis that found very little impact on the 15 CCP service lines studied on the default loss side, either from taking the CCP's worst historical credit loss scenario, multiplying by 1.4 and applying cover 4, or looking at liquidity, the use of maximum cash calls and 100% VMGH. Nonetheless, the report noted some limitations in the analysis and concluded that FSB should continue to review the sufficiency of the existing toolkit for CCP resolution, focusing in particular on non-default loss scenarios. However, the 2023 consultation eschewed quantitative analysis, a deficit that a number of commenters on both sides criticized. Both sides also opposed the use of VMGH for non-default losses, with commenters noting that the guidance should avoid tools that would undermine closeout netting for bank capital purposes. I would note that VMGH for NDLs may well be just such a tool. Commenters on the CCP side expressed that resolution-specific resources and tools for default losses could weaken or remove the incentive for participants to effectively support default management recovery. Quote, consultation disregards the outcomes of the March 2022 report because the consultation lacks supporting data and quantitative analysis. While ignoring contradictory data in the public sphere, it may not provide relevant regulatory authorities and local jurisdictions sufficient basis to implement any of the proposals. Indeed, one commenter pointedly stated that if the CFTC were to undertake a rulemaking to adopt the consultation's proposals without adequate data-based analysis regarding relevant costs and benefits involved, its rulemaking could face a legal challenge. By contrast, market participants were of the view that, quote, a greater balance of loss allocation towards CCPs relative to clearing members and participants looking across recovery and resolution would better align risk management incentives and promote better outcomes from a resilience, financial stability, incentives, and market confidence perspective. They were generally opposed to VMGH for default losses, although they acknowledged it could be used with strict limitations. Turning to the recovery and wind down rulemaking, on June 7th, the Commission approved a rule proposal that would revise the existing requirements for DCO recovery and wind down plans. It was broadly designed to accomplish three goals. First, to codify existing staff guidance on recovery and wind down planning for SIDCOs and Subpart C DCOs. Guidance is informative, but not binding. Regulations are binding. Second, it would newly establish wind down requirements for all other DCOs. Some of these are foreign-based, and so already have wind-down plans pursuant to their home country legal framework. Others are US-based, and the intent is to ensure that they have orderly wind-down plans. Now, just a few years ago, the Commission approved amendments to our Part 190 bankruptcy regulations that would explicitly cover a DCO bankruptcy. I've observed before that in a bankruptcy, the only parties that make out well are the lawyers and other professionals. In light of many new DCOs, including those whose members are retail participants, it seems essential to have orderly wind-down plans as an alternative to bankruptcy. However, the requirements for these DCOs were proposed to be intentionally less rigorous than those for SIDCOs and Subpart C DCOs. In addition to not requiring recovery plans, the requirements here would be more focused on making sure that the wind-down plan is credible and that the tools can effectively be used. And the third function was to obtain information for resolution planning. Now, as background, our current regulations require plans that identify scenarios that may potentially prevent the DCO from meeting its obligations and providing critical operations and services as a going concern, and to assess the effectiveness of a full range of options for recovery orderly wind down. As a result of supervision and developments in international guidance, in 2016, DCR issued the current staff guidance, letter number 1661. Much of this rulemaking incorporates the substantive elements of letter 1661, although to be frank, the proposal does indeed go beyond them. The proposal is fairly detailed, arguably prescriptive, with respect to the recovery and wind down planning processes. However, it seeks to be non-prescriptive and leave DCOs considerable discretion with respect to the decisions they make about the content of the plans and with respect to the decisions DCOs take in executing those plans. The proposal would require analyses for recovery and wind down plans that are similar to those identified in 1661. For instance, the DCO must identify wind down triggers, scenarios, and tools. However, the proposal goes somewhat further, requiring that the DCO identify its financial and operational interconnections and interdependencies, plans for resilient staffing arrangements, governance structures, and contracts or agreements subject to alteration in the event of wind down, as well as the service providers relied on for critical operations and services, and contrastingly, any critical operations or services it provides to other financial entities, and finally, obstacles to the success of the plan. 1661 covered plans for regular testing. The proposal would require the testing of recovery and wind down plans on at least an annual basis. And additionally, SIDCOs and Subpart C DCOs would conduct the testing with the participation of clearing members where the plan depends upon that participation. The rulemaking enumerates certain non-default loss scenarios that the DCO would be required to address if, but only if, they are applicable. These include settlement and custodian or depository bank failures, investment risk, and legal liability unrelated to the DCO's business as a DCO. One lesson that we've recently relearned is that it is important to avoid conflating low risk with no risk. For instance, many used to consider the default of a regulated bank as an irrelevant scenario, since large banks don't fail. That assumption fell last March. The proposal would also require that the DCO consider any combination of at least two scenarios involving multiple failures, especially relevant to the DCO's business, and that the plans address cyber risk from malicious actors. The Commission has received a set of detailed and very well thought out comments. Some commenters want the Commission to go further and impose requirements on the substance of the plans. Others say that the proposal is far too detailed. And some commenters pointed out places where the language used in the proposed rules might lead to unintended consequences. Now, our colleagues at the SEC are in parallel going through their own rulemaking on clearing agency recovery and orderly wind down plans. We've been in contact with and have coordinated with our SEC colleagues. I will observe that while the rule text of their proposal would seem to be far less detailed than ours, given the fact that SEC has a process for approving such plans in advance as rule filings, and the points SEC made in their preamble as to their expectations with respect to those plans, I would submit that both proposals get to the same end place, though by different routes. We're still in internal discussions to determine what the specifics of the final rule proposal or proposed to the Commission might be, though I will note that at the very least, staff will be paying close attention to concerns about how the proposed rules might be adjusted or redrafted to avoid unintended consequences. Thank you.
Great. Thanks, Bob, and thanks to our speakers. I'll open it up to the floor for comments. Okay, we'll now turn to the fourth panel of this section, which discusses margin and collateral. First, we'll hear from Dmitry Senko, Chief Risk Officer of Eurex Clearing AG. Dmitry.
Thank you, Chair Crichton. Thank you, Commissioner Johnson, Commissioner Mersinger, and CFTC staff who helped to organize and for the possibility to share the progress update of the workstream margin and collateral guidelines. The workstream participants are people representing different parts of derivatives industry. We have Joseph Garalik from the BlackRock. We have David Horner from LCH. We have Raj Ramanath from JP Morgan and myself from Eurex Clearing. We worked on a prioritized set of topics, and I will outline them one by one. So we worked on the topics transparency for margin. Second one is anti-procyclicality. Third one is margin period of risk. Fourth is collateral margin calls. Today is only the progress update as we are planned for the work to before providing recommendations. We looked into what happened since last report was presented in 21, what market developments happened since then, what industry practice, how industry practice evolved, and what are the known viewpoints on the topics. As you can see, the topics were already with us for a few years, so we looked whether update of the recommendation from the last report is needed, but we want to do it on a reasonable analysis that is performed before that. So we are currently where we are now. We looked at all that, and we are currently assessing the discussion landscape before we progress to recommendation, which we will work out in the next few months and present you next time. On margin transparency, few words were mentioned today already. We looked into recommendation last time in 21, and this acknowledged already the importance on the topic. and referring that further work will be conducted separately. Overall goal here is to enable market participants liquidity planning and risk management by providing information on margin model reaction on certain market conditions, including how margin calls work resulting out of the market developments. In the work stream, we discussed different viewpoints on that topic, one being that a lot of things are already in place. That's one viewpoint. Another viewpoint is that still more enhancements can be done, and all those ideas for what to be enhanced can be split into different categories: descriptive aspects, empirical aspects, and operational aspects. As for descriptive aspects of transparency, it could be enhanced, the description how the margin model works, including the add-ons and margin parameters, etc. All in all, it's a qualitative description, but could allow replication of the margin model on a standalone basis. As for empirical aspects of transparency, CCPs could extend quantitative disclosures of margin-related metrics, including breakdowns into base margin, add-ons, and, for example, margin backtesting performance. CCPs could provide the tools for members to facilitate understanding of these breakdowns, also including potential what-if analysis, what happens if portfolio changes and new positions come into the portfolio. As for operational aspects of transparency, CCPs could disclose procedures for intraday risk monitoring, including triggers, thresholds, for example, how much margin erosion is tolerated before margin calls are done. In addition to those three types of aspects, empirical, descriptive, and operational, we discussed also to whom which information should be disclosed. So who are the recipients, and maybe stratified approach is necessary, or whether it is necessary or not. Members, all members and clients, individual members, individual clients, supervisory authorities, could be different groups or subgroups, and how disclosures are made, publicly, privately, tool supported, etc. Coming to the second topic we looked at, anti-procyclicality. We pre-discussed that there are several factors for cyclicality, both variation marginal effect, initial margin effect, and the bigger one is probably VM effect, but we focused our discussion on IM effect, so IM cyclicality only. Comparing to recommendations in 21, we agreed that CCPs should retain the ability to choose appropriate means of mitigating procyclicality. Further, we discussed that there is room for standardization of procyclicality metrics, and we discussed the flavor on the different dimensions that are relevant there. One could be short-term metrics, long-term metrics, and also we discussed idea about metrics that are relating to some model-free measure of volatility. In terms of aggregation level, it's also important to differentiate that it doesn't make sense, or there is some precautions to be known if looking at portfolio level measures where portfolio is changing over time, so the procyclicality metrics may be not giving the full analysis. So procyclicality assessment on special on product level or on some fixed strategies could be necessary to understand the dynamics. Further, we discussed the necessity to strengthen the cyclicality in terms of governance and framework around it. For example, disclosure of the framework, how CCP strikes the balance between margin stability and backtesting performance. There is some trade-off there. Stable margin can result into low backtesting results. And CCPs could outline the details of chosen procyclicality metrics, target levels of these metrics, and what thresholds are there, and what investigation CCP would perform if some of the metrics are exceeded. In addition to discussing this backward-looking procyclicality measures, we discussed the forward-looking procyclicality disclosures that could be done by, for example, replaying or doing a what-if, what can happen if crisis repeats or some crisis situation evolves, so what would be the margin reaction. We also discussed in order to achieve the overall goal of overall financial stability, is a value of understanding the cyclicality developments also in the in uncleared space and the interplay of what happens in cleared and uncleared together. In terms of margin period of risk, we compared also here with the recommendation in 21. Their outlined criteria are mainly still valid. Since then, we observed a few more crises and notable events happened with increased attention on initial margins. So considering those two additional data or few additional data points and perspectives, we discussed whether further recommendation or making it more precise, whether it is needed. In the workstream, we discussed the competing viewpoints and the trade-offs on the MPOR. On the one hand, the importance of MPOR to enhance the risk management, providing more time to react in adverse market conditions. And on the other hand, implications on economics of trading, where excessive margins may stifle trading activity and lead to market inefficiencies. Also, we discussed if this should be viewed as a product-specific approach. So, for example, addressing margin period risk for only energy or commodity space, or a general liquidity-based argument, which is true for across different asset classes. Initial margin should cover losses faced by CCP during default management or until CCP returns to matched book following member default. And there are two more primary sources of this loss: market risk between the last successful margin collection and until CCP is balanced, and the liquidity concentration risk that can materialize when additional price pressure comes when liquidating big position. So we discuss as well that porting is also part of one element, one instrument that helps CCPs to return to match book, whether different approaches should be applied to MPOR, considering that there is porting approach with different mechanics from the liquidation approach, where potentially auctioning happens, whereas in porting it's ported and maybe lesser market impact is happening. So that's the discussion we had. We also discussed different alternatives to ensure appropriate of margins, such as one is requiring a minimum of 2 days MPOR, or appropriateness of a more differentiated approach where level of concentration margins for larger portfolios is sufficiently adjusted to reflect shorter holding period. Further, we discussed different perspectives on margins with respect to margining practices and the role they play in CCP risk management vis-a-vis clearing members and risk management between members and clients. In that respect, in the latter respect, the margins are not only there to protect CCPs from and surviving participants in case of clearing member defaults, but also used by clearing members to manage client risk. Coming to the last point on margin calls, we discussed that beyond the core purpose of margins to act as a first line of defense to collateralize cleared exposures, margin calls can influence procyclicality. Previous report in 21 on that elaborated on many aspects and recommendations, and they are still valid. In the workstream, we discussed different types of margin call processes: scheduled, event-driven, and ad hoc, differentiating between event-driven and ad hoc, two different ones. We discussed one sub-dimension is whether margin calls require or don't require VM pass-through, and implications if VM pass-through is, for example, not possible if non-cash collateral only collected. If cash is not collected, then VM pass-through is not possible. We noted also the known trade-off between lowering of frequency of margin calls and the level of tolerable margin erosion. So the less frequent margin calls are done, the more margin erosion can happen in between those calls. In addition, we discussed the margin practices along the overall chain between CCP members and clients and different velocity of margin movements along this chain. Further, interrelation with other topics like anti-procyclicality and margin transparency may require that we combine this topic with the other ones. So with that, that's the progress update so far, and we hope that in the next few months we are coming up with more recommendations. And with that, I hand over back to the organizers.
Great, thanks very much, Dimitri. Before we transition to the Market Structure Subcommittee, I'll pause for any member comments as we close out the CCP Risk and Governance. I'll recognize Jennifer Hahn.
Sure. Can you explain a little bit more with respect to client collateral and margin? Is that segregated? And then maybe to Bob's previous discussion, in a default, where does that fall? Is that at the top of the waterfall or is that at the general default fund?
So let's take it a few points there. Margins, and for different client access models, there are different client access models, strongly segregated and individually segregated, or gross omnibus segregated, net omnibus segregated. So that's to just to mention how much margin and where it is held and what's the risk of to your peer clients is different in those different models. In terms of where margin sits in the waterfall, that's unchanged. That's margin is first line of defense in the waterfall. Then comes, if that's not sufficient, then it's skin in the game of the CCP. If that is not sufficient, then it goes, before is a default fund contribution of the defaulted members, and after skin in the game, it's default fund of the remaining clearing members. So that's pretty similar across CCPs.
On what you said. So when you say margin is the first line of defense, is that the client that is in deficit, or is that also if you are another client? So like if I'm, would my margin be at risk if another client is in deficit? Like would my margin be taken to use to fill a gap due to another client's?
So yeah, we are coming to mechanics of default measure. When clearing member is in default, then the question is posing: can clients be ported or not? And if they are, let's say, segregated from each other, individually segregated, then what's the situation with their backup clearing member? Are they going to be accepted? In that phase, it's not allowed the spillover is not allowed between individually segregated clients. But coming to another example, in Europe, there is net omnibus account structure there. It's not transparent to CCP who are the clients, and there they are treated as one account. So there, some customers are subject to peer client risk, if you want. But let's say individual segregated. If porting can happen, then that's the best outcome. If porting cannot happen, then such client positions, portfolios are liquidated, and then also there is no spillover possible to the others. So everyone is liquidated, and then the margin is held against what are the proceeds from the liquidation of that single account. So in that respect, individually segregated setup is most protected from peer client risk.
Thank
Bob, we'll turn to you.
Yeah, to your point, in the US, of course, on the future side, you do face fellow customer risk because, as mentioned, it is one account on the omnibus. However, of course, on the cleared swap side, we have LSOC, which means you would not be facing fellow customer risk. Although, again, if the margin has gone missing, then there would be risk there.
Recognize Marnie Rosenberg.
Thanks, Alicia. Thank you, Commissioner Johnson, for your continued sponsorship of the MRAC, and Alicia as the MRAC chair for the continued focus and support of the CFTC's CCP Risk and Governance Subcommittee on enhancing CCP risk management. And Dimitri, we welcome the priority areas identified by the margin and collateral workstream, which we're involved in, ensuring transparency and predictability of margin models, evaluating impact of margin call processes, determining metrics for measuring and addressing margin procyclicality, and revisiting the impact of different margin periods of risk and assessing alternatives to ensuring adequate margin. It's encouraging to hear that the work stream is building upon the prior work and the recommendations that several of us worked on from 2020 to 2021. We look forward to also reviewing the recommendations from the group. I also wanted to voice our support for the important work being done in the recovery and resolution and the tech and ops work stream, which tie into the valuable global work in this arena. So we look forward to really focus on these recommendations once each of the work streams is prepared to share it with the full MRAC. And thanks, Alexandra and Chris Edmonds, for leading this subcommittee. We look forward to seeing all the recommendations from across the work streams in the coming months. That's all.
Great. Thanks, Marnie. Any other comments in the room or on Zoom? Oh, sorry. Juan.
Thank you. I just wanted to expand on Jennifer's comments. With respect to, so Bob, you mentioned LSOC, and we're very thankful as end users that for the mandatorily cleared products, LSOC was created. However, if IM does not remain sacrosanct, and we're aware of the fellow customer risk, I do not believe recovery or resolution for a CCP can work. Because as you move further down the waterfall, it requires those of us that manage money for other people to go to our board or the people who have given us the mandates and ask them if they're willing to put good money behind bad. That's a very difficult ask.
Alessandro.
Thank you, Alicia. And still building on what Juan mentioned. So, Jennifer, I guess the question, as mentioned, you need to look at the, what model of segregation you have depending on the type of product in the region where you're trading. And then when you get to the end of the waterfall, that's when you want to really understand what happens in a recovery or resolution scenario, because depending on the model, you may have variation margin haircutting. So even though you're the winning party, the party that has a gain, and you're not the defaulter and your clearing member is okay, there may still be, depending on the choices that are made, a shortfall that then will require you to speak to your board and to your investors. So I think that understanding those models, and something that Bob mentioned to me, the fact that something is low risk does not mean you don't have to prepare for it and have a clear understanding of what happens, because especially in contexts where you have mandatory clearing, you have to make sure that the service continues. And there are, again, those policy choices that I mentioned earlier in terms of who bears losses in a recovery and resolution situation. Thank you.
Great, thanks, Alessandro. And if I may, Jennifer, just on one of your points regarding margin being the first line of defense, I think the reason why we focus on that and really kind of think about that as, one of the overarching themes and really part of the advocacy of so many folks in this room is, we want to ensure that margin is appropriately calibrated and customers have enough on deposit in much more of a uniform fashion, right? Margin shouldn't be sort of a competitive advantage across firms or CCPs. So ensuring that it's appropriately calibrated by asset class and by product is one of the things that we focus on the most, and ensuring that calibration, ensuring the robustness of that initial margin regime. We think really in that context, that's how it's the first line of defense, making sure that there's enough collateral on deposit to withstand the risks that we have seen and continue to see.
Great, thank you.
Lee.
Thanks, Alicia. Following on the same point, I did want to reiterate that in a clearing member default at CCP, one of our first priorities is to look to port clients to non-defaulting clearing members. The CFTC regime, which has customer gross margining, has bulk transfer rules, is one which is set up to support porting, and we have successfully done that in the past, and that is porting positions to non-defaulting clearing members along with associated collateral. So we are set up to be successful. We can't guarantee it, obviously, but we are set up to be successful for that in the CFTC regime.
Thanks, Lee. Bob?
to Lee's point, of course, in order to have successful porting, you need to have willing transferees. And as Lee mentioned, we have been very successful in the past. That is becoming increasingly tenuous given the reduced number of FCMs we have. And indeed, to the extent that bank capital rules make such porting less attractive to potential transferees, or indeed potentially damaging, it makes life that much more difficult. Thank you.
Thanks, Bob. Exactly. As the commissioner just said, that's actually a perfect segue into the Market Structure Subcommittee. For our first panel of this section, Ashwini Pants, Head of Risk Oversight for ICE Clear Netherlands and Chief Risk Officer for the North America Clearinghouses. Ashwini.
Thank you, Chair Crichton, Commissioner Johnson, Commissioner Mersinger, and CFTC staff for the opportunity to speak today on the topic of FCM capacity. I would like to acknowledge all the members of the work stream and the Market Structure Subcommittee members for all the active discussion that we've had on the topic, the feedback, and the valuable input that has helped round our views. The FCM capacity work stream analyzed 20 years of FCM data published on the CFTC website. The data looks at trends relating to the number of FCMs, activity over the years, client margins, and capital requirements. The headline is one. There has indeed been some consolidation of FCMs overall, but there is still adequate competition and capacity from what we can tell. So the system still works. Two, costs in the form of capital, compliance, cyber, technology are high and growing. So we need to be thoughtful about how we balance risk with reward so new entrants can come to the market, existing players stay in the market, and costs are kept manageable as they are ultimately passed in some form back to the consumer. Today, I will focus on our top observations included on the first two slides. The remaining slides contain supportive data and charts. With respect to the number of FCMs, the futures industry has experienced a significant FCM consolidation over the period 2002 through 2023. We have observed a 70% decline in the total number of FCMs, primarily led by the exit of many independent FCMs who are neither dually registered as broker-dealers nor affiliated with banks or bank holding companies. However, the decline is attributable to not only the departure of many shell FCMs, i.e. FCMs conducting only retail Forex business, and non-carrying FCMs, i.e. FCMs that hold no customer funds, but to also to the shrinkage of an important group of FCMs who hold customer funds intended for futures trading, carrying FCMs. We're seeing a decline of 91% of non-carrying FCMs, 58% of carrying FCMs, and as of today, only 4 shell FCMs remain. A succession of increases in minimum capital requirements has resulted in the near elimination of the shell FCMs. When we look at firms doing cleared swap business, number of firms have reduced from 23 in 2014 to only 17 in 2023. We have observed exits and downsizing by some notable firms in recent years, including Boney Mellon, State Street, Jefferies, Nomura, RBS Securities, New Edge, who exited the cleared swap business in 2015, followed by Deutsche Bank Securities in 2017, and Credit Suisse, as you all are aware, had begun reducing the client activity even prior to the sale. Let me jump to the 2 essential primary financial safeguards. First, one, segregation of customer funds from proprietary funds and trading activities of the FCM. Second, maintenance of minimum capital, given FCM's capital provides a backup layer and an added layer of protection to an FCM's customer base from potential large trading losses of a customer, which could exhaust the customer assets and potentially expose other customers of the FCM to the risk of losing their own funds. Let us look at the growth in customer funds and adjusted net capital across firms. During the same period of 20 years, where we observed a decline in the number of FCMs, even as a swap clearing requirement went into effect, we are seeing a rising demand for clearing. We observed a 700+% increase in the holding of customer funds. Going back 20 years ago, when the pot of client margin requirements aggregated to $60+ billion US, in 2023, the highest we have seen the requirements rise to was north of $500+ billion US. Today, the remaining FCMs are dominated by the larger FCM brokers who now hold all top 10 industry positions in terms of holdings of customer funds. And these 10 FCMs account for 80+% of all customer funds. Similarly, we have observed an increase of 296% in firms' adjusted net capital. Going back 20 years, across the firms, adjusted net capital was $45+ billion US. In 2023, it is north of $179 billion US. As a whole, the remaining FCMs are well capitalized, and most hold significant excess capital relative to the CFTC minimum requirements, with the FCM broker-dealers and the bank-affiliated FCMs holding significantly greater levels of excess capital than independent FCMs, primarily due to the fact they need to adhere to other more stringent regulatory or jurisdictional capital requirements. Excess capital that FCMs are maintaining support FCM's financial solvency, reduce systemic risk, and enable them to meet the rising costs stemming from regulatory requirements and technological advances. However, in our review of the data and our conversation with the dealers, our initial analysis has also attempted to rationalize why there are fewer new entrants. Providing FCM services has become an increasingly high fixed cost business, with the costs of infrastructure and regulatory compliance climbing materially post-Dodd-Frank. This makes scale critical to running a successful FCM. In many cases, with firms taking a more holistic view of the largest clients across their franchise, i.e., not just clearing, but associated businesses such as prime, repo, execution, etc. As a result, smaller FCMs may not be able to generate enough money to justify the costs of infrastructure and regulatory compliance. And what we have seen is that the clients have been gravitating to the biggest providers, generally all banks. However, data also remains supportive of the fact that overall, FCM business continues to be very competitive. FCMs across the board have been able to absorb the growth in client activity and meet margin requirements, including in periods when margin levels increase sharply due to market volatility. That being said, it is critical that capital rules remain risk sensitive, incentivize clearing, and additional burdens not be placed on firms providing the service. There are some instances where the big bank FCMs have become more restricted on offering the service, particularly post-SACA rollout, when these products became disproportionately expensive. While we have seen some smaller non-bank FCMs step in aggressively in these instances, it is also the case that some of this business was taken OTC, and some market makers exited the markets where the capital requirements became too punitive, impacting liquidity and therefore the cost of hedging for commercial participants. We have seen recently, as a result of heightened volatility in certain energy markets and large increases in margin requirements during that period, meant that many commercial participants using cleared markets to hedge commercial price risk hit various thresholds, including some capital thresholds with their FCMs. The result of which was that they either took these hedges OTC or in some cases took the hedges off altogether. Tying up too much capital has the effect of reducing the headroom for when the market stresses occur. FCM concentration, coupled with new capital rules, may make the possibility of porting more challenging. When Lehman happened, Barclays took all the clients. If the same scenario were to occur again, and one of the larger clearing members took a hit, I think the regulators and the industry should really be concerned about how likely is it that another clearing member will step forward to take on all those clients if that member is already at capacity with the proposed capital rules. If we go to the next slide, for instance, the more recently proposed capital rules, like the GSIB surcharge and Basel III endgame, can impact client clearing and have the potential to further reduce capacity in cleared markets. It is important to bear in mind that uplift in capital have real impact on the business that banks do on a desk-by-desk basis and on a business-by-business basis. As the hurdle rates change for those businesses, banks will have to make decisions about where to grow and invest relative to where to reduce or eliminate certain activity that they do. The GSIB buffer is supposed to disincentivize activity that is seen as systemically risky. The proposal to include OTC client cleared leg to the complexity and the interconnectedness indicators of the GSIB surcharge is counterintuitive because it is well proven that clearing reduces complexity and interconnectedness. The inclusion does not align with the actual risk presented by this activity. It departs from the existing framework without adequate explanation, may reduce capacity and willingness of banks to intermediate client clearing, and contravenes the long-standing public policy objective to promote central clearing. If we look at the Basel III endgame proposal, with the capital stacks being restructured, the impact to trading activities will be quite significant. For instance, the services component of the operational risk capital relating to the fee and commission-based revenue is widely acknowledged to be punitive in nature and essentially a tax on revenue, which is very difficult to optimize around. If we look at the credit value adjustment capital charge, inclusion of client clearing is unnecessary as the only client-related credit risk that the clearing member faces is the risk of client default, which is already captured in the existing counterparty credit risk framework. Also, it is worth discussing equivalency of US implementation with what we see in other major jurisdictions like the UK and the EU, where exemptions are in place. Another element of the new proposal penalizes exposures to foreign banks with higher risk weights and charges more capital for counterparties that are investment grade, highly creditworthy, but do not have publicly traded securities. I will close my remarks by saying that we recognize that there's a need to make sure that derivatives activity is appropriately capitalized, but that needs to be done in a way that recognizes existing risk mitigants in the system and in a way that's consistent with broader policy objectives. We could see changes in types of participation, which could present a different type of systemic risk, and something we should all carefully think about if we want to incentivize. Separately, we also believe it is critical to ensure that the proposed capital rules do not impede implementation of potential clearing requirements for the US Treasury securities transactions if the SEC finalizes its proposed rule on this issue. With that said, I would like to invite feedback from the full MRAC to ensure we have input and consensus around the work stream's observations prior to considering any potential recommendations. Thank you.
Appreciate it, Ashwini. Thanks very much. Maybe I'll start with a few brief comments and then we'll open it up to the floor for discussion. I'll primarily focus just on the capital comments in the materials that you just reviewed. I think while we have highlighted there are really a number of concerns, the kind of top list is here. I think we'll really focus on probably the two most concerning aspects, which is the inclusion of the CVA charge for client cleared derivatives, as well as the inclusion of the notional of the client cleared leg in the GSIB calculation. CVA is intended to capture mark-to-market losses or counterparty deterioration absent a client default. These types of losses do not exist in the client cleared model. Counterparty default risk does exist. However, we are capitalizing for that already, as you indicated in the SACR framework. These proposed changes to GSIB were discussed and ultimately not implemented in 2017 with the view that significant impacts to the client cleared model and to the FCM capital footprint would disincentivize clearing. Post Dodd-Frank, goals in the clearing mandates were to simplify and standardize, and markets have rightly benefited from that. However, we're reaching a new tension in the system with a concentrated pool of FCMs offering much needed capacity to the client cleared ecosystem. The consequences, if the proposals are implemented as drafted, will be significant and will exacerbate the FCM concentration issues we're already experiencing and likely have a second order risk impact of introducing new participants into the mutualized pool. We urge regulators to focus on these issues, and thanks for your time. I'll open it up to the floor for more feedback and comments. Sorry, Andrew.
Thank you. I'd echo Alicia's comments, but also, Ashwin, I thought that was a very well done presentation. It's very data driven and it's taking a 20-year time horizon for perspective, which is a nice way to see it. I would just call out some of the trends that you highlighted, both in terms of the concentration of the number of FCMs and the rising balances at those FCMs. And to tie it back to Bob's comments from the prior panel, ultimately, the question is, what is the impact on portability and the impact on customer access to clearing services? That might be an area for further investigation by the subcommittee in the coming year. And then to amplify two other points that have been alluded to, what's, I think, interesting about this topic is the intersection with two other regulatory regimes. Insofar as the FCMs are largely subsidiaries of large US bank holding companies, you have this top of the house Fed capital rulemaking structure that has been pushing down capital requirements to these business activities, so outside of the Commission's direct purview. The second, which has also been alluded to, is that oftentimes the FCMs are dual registered with the SEC as a broker-dealer. And so the SEC has announced on Wednesday of this week it's intending to adopt a final rule to mandate clearing in US Treasury securities. One might expect, all else being equal, that those Treasury clearing services will be conducted out of the same entities and will put further capacity pressure on the entities that are offering both commission-regulated clearing services as well as those for Treasury. So the issues become more amplified for all the reasons that you previously highlighted. Alicia, I think did a nice job summarizing the ops risk and CVA issues, so I won't call up those out any further. My last observation would be just in terms of future work that the subcommittee might do or might consider. I think that this presentation did a wonderful job of summarizing the data trends for the FCM specifically. Another perspective of it might be trends we've seen with clearinghouses and whether the relative market share of clearinghouses and the products that they're clearing have changed, or in what ways have they changed over a similarly long time horizon, so that you could see both the FCM and the clearing side of the equation. Thank you.
Thanks, Andrew. That's helpful. Tyson?
Thank you very much. Excellent presentation. So I was really interested in the chart on page 24 of the handout that we've all been given. And it seems like it's documenting the 70% decline in the total number of FCMs. And it looks like there's a couple of key data points here. One appears to correspond with the 2008 financial crisis, and the other appears to be in 2014, 2015, and since then has sort of leveled off. And so I'm just wondering if the committee is looking at whether or not the role of mergers and acquisitions has played a role in this concentration. And particularly, you noted the significant barriers to entry for new participants, the infrastructure needs, whether or not mergers and consolidations have contributed to those barriers to entry and therefore removing some competitiveness, perhaps. Thank you.
We did, just to highlight, I think, in the back pages of this presentation, we've looked at, every 5 years, years who's remaining. And you're right, we have seen a lot of consolidation happening over the years, which has contributed to it. And I think that combined with, the 2008 crisis that happened, and then the new capital rules and requirements that came into play, I think it's a combination that we've observed, where we've seen a lot of, FCM capacity, number of FCMs declining. As you see, clearing is still, there's a high demand for clearing. And so that hasn't stopped. There's a rise in, customer funds that has, over time only increased. So the demand hasn't gone down. we've just seen some consolidation. And I think that's, like you said, mergers and acquisitions plus some of the members have just exited because of the capital rules that we.
Thank you.
Marnie?
Thank you, Alicia. Yes, some of my remarks will be similar to what Alicia and Andrew said, which we would support as well. So first, thank you, Ashwini, for the detailed presentation on trends and FCM capacity over the last 2 decades. I think it's really helpful and for folks to see that. I guess looking forward, we are concerned that the proposed Basel III Endgame capital rules and amendments to the methodology for the GSIB buffer could further disincentivize bank-affiliated FCMs for providing client clearing services. I think that's a general comment that several others have made. We're particularly concerned with the proposed inclusion of agency-cleared notionals and the complexity and interconnectedness components of GSIB. It's counterintuitive, since central clearing reduces complexity through the standardization of derivative contracts and reduces interconnectedness by replacing bilateral exposures with the central counterparty. Rather than encouraging central clearing, the proposed changes would effectively normalize the treatment of uncleared and cleared derivatives in GSIB, undermining the longstanding policy goal to increase central clearing. Ultimately, this could act as a disincentive for banks to offer or continue to invest in a client clearing service, would reduce the likelihood of successful porting of client trades in a stress event, and limit the opportunities for a client to change clear even absent a member default, so in sort of business as usual circumstances. While we acknowledge the need to ensure that risks arising from the bank's cleared derivatives activities properly capitalized, it is critical that this is done in a way that recognizes the significant existing risk mitigants, such as the exchange of margin, the CCP waterfall and default fund contributions, and doesn't undermine the broader policy objectives to support and encourage the use of cleared derivatives to manage risk. And I think this is particularly significant in the context of the analysis that Ashwini presented today. So thank you.
Great. Thanks, Marnie. Okay. Seeing no other comments, we'll turn to the second panel of Section 3, Treasury Market Reform. First, we'll hear from Sam Schulhofer-Wall, Senior Vice President and Senior Advisor to the President of the Federal Reserve Bank of Dallas. Next, we'll hear from Ann Battle, Senior Counsel, Market Transitions and Head of Benchmark Reform for the International Swaps and Derivatives Association. And finally, we'll hear from Jennifer Hahn, Chief Counsel and Head of Global Regulatory Affairs of the Managed Funds Association. Sam, please begin.
Thank you, Chair Crichton and Commissioners Johnson and Mersinger. My name is Sam Schulhofer-Wohl. As Chair Crichton mentioned, I'm Senior Vice President and Senior Advisor to the President at the Dallas Fed. I've been closely involved in work to support the resilience of Treasury markets, including through collaborating with the Interagency Working Group for Treasury Market Surveillance. Today, I'll review the state of play as I see it in efforts to enhance the resilience of the Treasury markets. I'll then take a deeper dive into one dimension of those efforts, possibilities for expanded central clearing and how clearing relates to the cash futures basis trade. My remarks represent my views and not necessarily those of the Dallas Fed, Federal Reserve System, or any other organization. Because today falls in the communications blackout period ahead of an FOMC meeting, I will not comment on current or prospective economic and financial conditions or the Fed's policies and tools. No inference should be drawn from my silence on these matters. The history of the Treasury markets, including those for cash securities, repos, and futures, has been one of ongoing evolution, crucial to ensuring that these markets can continue to reliably serve their vital purposes. I date the current chapter of the market's evolution to the stresses in repo markets in September 2019 and the dash for cash at the onset of the pandemic in March 2020. Following those episodes, experts began examining how to mitigate the vulnerabilities they revealed. The IAWG, which consists of staff from the Treasury, Federal Reserve Board, New York Fed, SEC, and CFTC, launched work streams to evaluate policy issues and options in 5 areas. Significant progress has been made across all of them, and I'd highlight in particular the numerous enhancements to data collection and publication, the Treasury's announcement of a buyback program, and the SEC's proposal for broader central clearing, which the Commission will take up this Wednesday. But the policy framework that the IAWG has established may be as important in the long run as any of the specific steps. In 2021, the IAWG staffs proposed 6 principles to guide public policy in the Treasury markets. They are, first, resilient and elastic liquidity; second, transparency that fosters public confidence, fair trading, and a liquid market; third, prices that reflect prevailing and expected economic and financial conditions; fourth, economic integration across cash, funding, and derivatives markets; fifth, financing that does not pose a significant threat to financial stability; and sixth, infrastructure that operates effectively and efficiently. The benefits of a principles-based approach to public policy are familiar to the CFTC and participants in the markets it regulates. In particular, the way that principles-based regulation can provide flexibility to adjust to changing conditions alongside clarity about desired outcomes. While the IAWG principles do not have the force of law or regulation, I hope they'll offer some of the same benefits in Treasury markets. I'll now discuss in more depth the potential for expanded central clearing and related the basis trade in light of the IAWG's principles. A substantial share of Treasury transactions is already centrally cleared. However, a significant set is not, including typical dealer-to-customer transactions and trade legs with principal trading firms on interdealer broker platforms. Several of the IAWG's principles provide useful frameworks for assessing the implications of broader clearing. First, resilient and elastic liquidity. During stress episodes, market liquidity has sometimes come under strain because balance sheet costs or constraints discouraged intermediaries from expanding the supply of intermediation. Central clearing allows for multilateral netting, which reduces the balance sheet intensity of intermediation and may permit dealers to more significantly increase intermediation when demand rises. Second, transparency. Because centrally cleared transactions are reported to the CCP, collecting data on them is straightforward. By contrast, collecting data on bilaterally cleared transactions has proven challenging. There still is not routine data collection for the $2 trillion non-centrally cleared bilateral repo market, though the OFR has proposed to close this gap. Broader central clearing would support more efficient data collection that could enhance transparency. Third, infrastructure that operates efficiently and effectively. The hybrid clearing model for transactions on IDB platforms poses a contagion risk to the CCP, which lacks visibility into non-centrally cleared trade legs. Moving all IDB transactions into central clearing should enable more effective risk management at the CCP. Finally, I'll take these 2 principles together: economic integration and financing that does not pose a significant threat to financial stability. In the Treasury markets, the economic integration trade par excellence is the cash futures basis trade. Market participants' ability to buy a cash security, finance it in the repo market, and short the corresponding future helps ensure 2 tight links between the prices of cash securities and futures and between the implied financing rates in repo and futures markets. A trader who puts on a cash futures basis position faces a couple main risks that could lead to delevering in the face of a shock. If the repo funding is overnight, it must be rolled until expiry and may become expensive or scarce. And although the trade has a defined return if financed with term repo and held until expiry, it can generate margin calls in the interim. Broader central clearing could mitigate both risks. It could support a more robust term repo market by efficiently centralizing risk management at the CCP. And if combined with an efficient and broadly available cross-margining arrangement, broader clearing could reduce margin calls on basis positions, as margins would be based on the net risk of these positions, which is much smaller than the gross risk. Work beyond adoption of the SEC's clearing proposal would be needed to fully achieve these benefits. Most notably, the new fixed CME cross-margining agreement still covers only clearing member portfolios, not customer portfolios. But one shouldn't take this or other current challenges to customer clearing as given. Importantly, the SEC's proposal would modify Rule 15c3.3 on segregation of customer funds. This change would open a path to lower costs of customer clearing. Under current rules, a clearing member at a securities CCP must post its own funds, not the customer's, as collateral for customer trades. This increases the costs of customer clearing, as I've documented in my research. From a derivatives perspective, it may seem surprising that customer funds can't currently be posted as collateral for cleared customer trades in the Treasury market. And I'm mindful of the deep dive we just took into the nuances of different modes of customer segregation in derivatives. And as we've discussed, separate margining of customer positions is standard practice in the markets that the CFTC regulates. But in the SEC's markets, it's different, and I'm encouraged that the SEC has proposed to allow clearing members at a Treasury securities clearing agency to post customer funds
as collateral for customer trades. Another way broader central clearing can support financing that does not threaten financial stability is by providing for uniformly strong risk management of repos. The OFR's pilot collection of non-centrally cleared bilateral repos found that 74% of such transactions against Treasury collateral are done with a zero haircut. While in some cases the cash investor may be protected by portfolio level margining, the data also show transactions that are simply unmargined. For example, with netted packages, repos and reverse repos collateralized by different securities as part of a relative value trade, it's common to set a zero haircut on the theory that the collateral perfectly offsets. But that doesn't account for the risk of a change in the two securities' relative value, which is the reason for the trade in the first place. Broader central clearing would apply the CCP's strong risk management standards to the market more uniformly. Lest you think I'm a total Pollyanna, I do want to acknowledge that broader central clearing has potential costs, such as costs for market participants to meet the CCP's risk management requirements and knock-on effects on market liquidity from market participants' higher costs. But as the IAWG has discussed, it is important to distinguish between private and social costs. When a market participant chooses not to centrally clear a trade, that participant may reap the savings from lighter weight risk management, but the market and society as a whole bear the cost of stresses when inadequately managed risks emerge. So while broader central clearing could have some costs for individual market participants and for market liquidity at normal times, those costs must be weighed against the market-wide benefits, especially at times of stress. Thank you. I look forward to today's discussion and to ongoing engagement with all of you.
Thanks, Sam. Anne?
Thank you, Chair Crichton. Also, thank you to Commissioner Johnson. So I'm going to give an update on the Treasury Reform Workstream of the Market Structure Subcommittee. This workstream is led by Nate Werfel from BNY Mellon. He's not able to be here today, so I'm speaking on his behalf. Thanks to him, the workstream members for their work, and also to my co-chair of the Market Structure Subcommittee, Biz Chatterjee. So the Treasury Reform Workstream has reviewed current topics related to U.S. Treasury reform with a focus on the work underway in the IAWG that Sam just described, on which the CFTC sits. We have specifically focused on topics that affect the derivatives industry, including the significant Treasury futures market at the CME. As a result of these discussions, the workstream has decided to focus on the Treasury cash futures basis trade in our work over the next 6 to 9 months. As part of our work, we expect to produce a detailed presentation or discussion with the MRAC during the first quarter of next year, and potentially follow up with recommendations and/or best practices for risk management of the basis trading. In light of recent media attention on the role of asset managers and levered market participants participating in this trade, the workstream specifically hopes to put the size of the basis position in the context of the growing market, understand the motivations for those positions, which do introduce the opportunity for arbitrage between economically similar instruments, but also include trading objectives completely unrelated to arbitrage. And finally, review how the positions have performed in times of stress. We welcome feedback from the MRAC on how the workstream should structure its presentation, and we're currently considering, first, a description of the basis trade, an explanation of what creates the basis with a focus on the long asset manager buy-side position and motivations for that position, an explanation of the role of liquidity providers and hedge funds in the short position, and the degree to which that position is levered using repo funding. A general review of the role of leverage in past episodes of illiquidity, potential risks of the basis trade, including for all the different players, that is, the futures position, the cash position, and the repo financing leg. And finally, specific examples of how the different players currently risk manage those positions. And as noted, we ultimately hope to expand on this last point to propose recommendations and/or best practices later in 2024. The workstream expects to analyze these issues under current market and regulatory conditions, but we will also consider the implications of recent proposals including the SEC's proposal on additional Treasury clearing, which it expects to finalize this week and which Sam also mentioned, as well as the SEC's dealer registration proposal and recent regulatory announcements related to cash futures margining. Our next step is to host discussions with asset managers, hedge funds, and dealers, many of which sit on the workstream and the market structure subcommittee, regarding their trading objectives and risk management practices. We welcome feedback on these next steps and what we've covered today, and look forward to presenting our findings early next year. Thank you.
Thanks, Anne. Jennifer?
Great, thank you. Thank you, Commissioner Johnson, Commissioner Mersinger, Chair Crichton, and staff for organizing the meeting today and for my invitation to participate here to present on the Treasury basis trade. And so I have a number of slides, and if we can start with 38, and this just sets the scene really, just to, as you can see from the graph, and we've all known Treasury markets are the largest and most liquid in government bond markets in the world. And as you can see from the graph, since 2000, the supply of treasuries has grown significantly to export the expanding US government debt. And so I put this here because really to help, again, emphasize that these markets, I think, as we all know, are significant, and to start imposing various rule changes without really understanding potential consequences for the modifications could severely disrupt these markets. And so I think also, turning to the next slide, another key part of these markets is that they're very diverse. You have a lot of different market participants, and this really helps support a robust and healthy market. And so when you look at it, it's a number of different types of entities. You have, the foreign entities, mutual funds, depository institutions, state and local government, hedge funds, private and public pensions, insurance companies, and US savings bonds. So we really think that as we look at potential changes, thinking about the composition of market participants and keeping this diversity is really key. I think it really helps support a robust market. When you start decreasing the number of market participants, the categories, you risk bringing a lot of fragility to markets, especially when you have extreme volatility or market shocks. So, turning to the next slide, and again, thank you to Sam and Anne for setting the stage on the Treasury basis. There have been a number of articles. It feels like every week, every day, we see articles about the basis trade in US Treasury markets. What is really a routine trade becoming frontline news and a lot of financial news sources, I think can be quite concerning. And so we, MFA, put together a primer to help demystify this a little bit and to really help frame the issues, as we think that sometimes the financial media is making this a little more interesting and sexy than it really is. So there are, and again, I think it's a pleasure speaking to such a sophisticated group that already has a lot of understanding of the basis trade and of course how this works in futures markets where it's very, very common. So many investors, you have mutual funds, pensions, and others, and really they rely strongly on the Treasury futures market. It's an efficient way for them to manage risk. There are also regulatory reasons that they prefer to transact in the Treasury futures market. And so this is a number of the participants who are buying Treasury futures. And so obviously you need a seller as well. Hedge funds have been highlighted in the news as the ones providing the bonds, who are buying from the cash markets and selling into the futures. And again, as many are aware with futures markets, you have a price disparity between the spot markets and the futures market. And so this is a common arbitrage trade, the basis trade, which takes place and has a lot of important features to it. By providing this arbitrage, you have a lot of benefits in the sense that hedge funds are increasing liquidity in the markets, they're dampening volatility, they're reducing the bid-ask spreads, really lowering the cost of government borrowing. I think that is a really key part of this. I know that as Sam had mentioned, if you think of what are all the costs, and I know you mentioned the cost of everyone as to just significant disruptions, but also another cost that everybody bears is the increased cost of government borrowing. And as our debt continues to expand, I think that it really cannot be lost upon us to really calculate and analyze what this cost means to the government, to taxpayers, and to the broader economy. Turning to the next slide. So again, we've seen a lot of articles, reports on collateralization of the basis trade. And so one of the key aspects, the price differences are small. And so oftentimes what happens is that market participants engaged in this trade may use leverage to make the trade economically viable. The collateral is posted in connection with the basis trade, includes both margin posted on the futures leg of the trade and any haircuts on the repo transaction to finance the cash leg of the trade. I think looking at the OFR data, you only see one leg of it. And so that has resulted in a lot of alarming headlines about zero margin on one leg of it. And so I think really in looking at and understanding this trade, you really need to understand or think of it with both legs. And so when you look at just the futures leg for the basis trade, market participants see it as over collateralized because it's only one direction, right? And so CME margins the futures, the short futures position as an outright directional position. And it doesn't account for the other side of it, which again, if you separate out, you might see is zero, but really it is the counterparty is looking at it with both legs and so is offsetting risk. And so that's why you may see 0% haircut because of the collateral on the futures leg. So I think it's really important to look at this as a single trade as opposed to breaking it up. The low haircuts for repo financing are really due to the master netting agreements between a dealer or prime broker who recognizes it's a package trade. So, and I think that that's one of the things that's oftentimes lost when people are looking at the zero margin on the repo side. So turning to the next one, again, as we look at solutions, and we've heard of a number of proposals to address risk management, and I think that there are already a number of rules in place, a lot of oversight, which does address leverage. It's not without regulatory oversight right now. So counterparty banks, through their own risk management protocols, will determine the margin requirements on hedge fund financing arrangements. Also, bank regulators are working with banks to ensure that there's appropriate counterparty risk management on the bank's side. Also, the Federal Reserve has noted that imposing additional limits could have negative impacts on the Treasury market. So again, I think important to look at the impact without just thinking of the trades separately, but looking at them as a whole, because I think knowing that a lot of the market participants providing liquidity into these markets right now, a number of hedge funds and others. So I think also looking at the broader markets, what we know is that central banks have been net sellers of it. You have the mutual funds, pensions, and others who prefer to be in the Treasury futures. And so you have a number of market participants there are banks and then there are hedge funds and other market participants who are really providing this liquidity. And again, I think there's adequate oversight seeing both trades, and they are the ones really buying the bonds and selling the futures right now. So I think proposals that address these changes need to consider also the liquidity implications. So adding to some of the oversight already, turning to the next slide, really there are a number of things already happening which provides oversight and transparency. And so regulators right now, there are cash transactions reported to FINRA through TRACE. The Treasury futures are subject to CFTC regulation. Centrally cleared repo data is being collected by OFR, and we know there are additional changes which we support. And also non-centrally cleared tri-party repo market data is collected by BONI, which is under the supervision of the Federal Reserve Board. So, there are reporting mechanisms already providing important information. Hedge funds are also providing a lot of systemic risk data to the SEC, FSOC, and others. And this is just also through SEC also has oversight of the fund, their investments and use of leverage through Form PF. So I think just to emphasize that there is oversight and regulation. We're not in the Wild West here. And so also putting this all into the framework when you're looking at the proposals out there and how various entities are regulated already. So going to the next slide, some of the proposals, and I think coming out whether from the SEC or others, again, you hear in addition to 0% haircuts, you also hear proposals that SEC is looking at a number that would address Treasury market structure. And certainly while we support modernization to Treasury market structure, and we've been engaged a lot, I think there are some real potential downsides to Treasury market and the broader economy through the current dealer proposal and the Treasury clearing proposals. So the dealer one, again, these ones expanding the scope of who is a dealer. And so not to get too detailed into the securities law framework, but we think that this is really statutorily based as to who is a dealer. The proposal right now is very broad, would bring in a lot of market participants, including hedge funds and other proprietary traders who, in our view, are not acting as dealers making markets in these various markets. I think the concern you have there is that you would be fundamentally changing business structures. So a lot of these entities, a fund, the actual hedge fund, as opposed to the advisor, in many cases will not be able to register as a dealer. And what that really means is backing away from that Treasury basis trade. And so I think that will certainly have an impact on Treasury liquidity. Similarly, with Treasury clearing, we certainly welcome enhanced client clearing. I think that there are a number of steps that need to happen before a mandate for clearing across the board for treasuries. And so again, looking at the proposal, I think there are a number of things that would need to happen. And one of the things I know mentioned is the customer cross marginalization. So that is a framework that I think also needs to be addressed. Some of the FIC rules, which currently in our view are anti-competitive and would actually reduce the number of market participants in this area, would, in our view, add fragility to the market rather than increase it. And so I think for a number of reasons, looking at the Treasury clearing proposal as drafted by the SEC would actually increase risk to the system, decreasing liquidity, decreasing the number of market participants engaged in this, and really increasing the cost of government borrowing. And so that is for payers, but also if you look at pensions, corporations, and others, mutual funds who are using Treasury futures, it's going to make it more expensive as well. So, as I mentioned, we certainly think that there could be a number of steps to modernize and enhance the Treasury market. And so, top of those, improving data collection through TRACE, expanding the use of voluntary central clearing in the dealer to customer segment. I think that's one thing that we've been advocating for a number of years now, which is increasing dealer to customer client clearing there. Another key aspect, and I think for those familiar with the CFTC's swaps rules, in this context, it is requiring clearing members of FIC to accept done-away trades. And I think with the swaps rule, you have a model already for give-ups and the rules that you have with respect to SEFs. I think those have worked well and could be used as a model. Because again, this is one key component which I think would really decrease the number of market participants and potentially add to market fragility. Providing for segregation of customer margin at FIC. And I think this fits in nicely with some of the things discussed earlier with respect to bankruptcy issues. And so one key component here, segregation of customer margin at FIC. I think that would provide a lot of protection for investors, because otherwise, facing another layer and level of risk. Right now, if you are engaged in the trade, you are faced with counterparty risk. And if the segregation of customer margin is not addressed appropriately, then really when you get into this mandatory clearing, your risk actually increases because you have counterparty risk, but then also you are facing risk of other market participants, dealers as well. And finally, as I had mentioned, introducing the cross-margining for end users for Treasury futures and cash Treasury transactions. We think that is really critical to preserving market liquidity. Without that component, I think a number of market participants will not be able to trade at the same level. And so a few things will happen. The cost of the trade will increase. The number of market participants providing or engaging in the basis trade is likely to decrease. It is going to increase the spread, increase costs for pensions, mutual funds, corporations using Treasury futures, and overall the cost of government borrowing. So this is a key piece we think is really important to get right before any type of mandatory clearing is required for treasuries.
Great. Thank you very much. Thanks to our panelists. I'll open it up to the floor for feedback and comment. Okay, great. Just being mindful of time, we're going to just push through rather than stopping for a break. So we'll turn to the third panel of Section 3, discussing the block implementation rule, and I'll turn the floor back to Anne.
Thank you, Alicia. I'm going to jump right in the interest of time, but many thanks, of course, to the members of this work stream and Elizabeth Kirby, who has chaired it. The Market Structure Subcommittee has previously noted that incorrectly set block size would adversely impact the ability of market participants to efficiently execute large-size swap transactions, unnecessarily impeding their ability to hedge risk through swaps. We strongly support the CFTC's recent extension of the new block thresholds from December 4th of this year to July 1st, 2024 next year. In an effort to better understand the volume and trading of market participants currently trading blocks and the implications that the new block sizes could have on this population, this workstream recently developed a set of questions for trading venues and data repositories. The questions focused on two data sets in particular: 10-year US dollar rate swaps and 5-year CDX. The questions which are available in the materials for today are not designed to assess the suitability of the new thresholds or any impacts they may have on market liquidity. However, they are intended to define data sets and study and understand the number of market participants trading blocks and how that could change. So second, there are questions intended to determine the scale and concentration of the block participants and their trading needs. We asked a question on recalibration of swap data to check the relevance and materiality of the difference between block sizes being used by the market today versus under 67% and 75% calculations. Next, we ask questions on recalibration of the scale and concentration of the number of block participants and their trading needs if the 67% and 75% calculated block sizes were to be used. Next, we asked questions designed to identify how the trading profile and reliance on block trading changes in volatile market conditions with a lack of liquidity, specifically using the first 3 months of global lockdown during the COVID-19 pandemic in 2020. And finally, we asked a question designed to compute SOFR block sizes and compare those to LIBOR block sizes. 2 CEF members of the Market Structure Subcommittee participate on this work stream and graciously, as part of their participation, provided responses to certain of these questions. The work stream recently analyzed those responses and can note that most swap dealers currently trade blocks for the data sets mentioned, and a meaningful number of non-swap dealers do as well, particularly in the case of 5-year CDX. Of those entities, in most cases, blocks make up less than 25% of their respective total trades, but in some cases, blocks make up more than 75% of an entity's total trades. 2022 data for 10-year US dollar rates is not reflective of what future trading will look like, because there was a general prohibition on trading LIBOR during that year, but at the same time, SOFR, the identified alternative to LIBOR, to which future block thresholds will apply, was not yet met in 2022. Market dynamics like these can materially impact the number of entities trading blocks, and therefore it is critical to ensure that the data set used to set block thresholds remains reflective of the market conditions in which those thresholds will apply. Similarly, data for the second quarter of 2020, again, the first 3 months of the global lockdown during the COVID-19 pandemic, indicates that volatile market conditions with low liquidity do in fact affect the number of market participants trading blocks. And again, it is critical to account for market dynamics during such periods of volatility when considering how to appropriately implement block thresholds. The MRAC Market Structure Subcommittee and the Block Workstream acknowledge the recommendations on these issues recently approved by the CFTC GMAC, and we support coordination as appropriate across the MRAC and the GMAC, as well as with industry groups that continue to advocate for appropriate block thresholds. It is likely that analysis of trading volumes and other data for certain products will be required as the industry works to understand the impacts that higher block thresholds would have on market structure and liquidity. The Market Structure Subcommittee will continue to support this work and is committed to streamlining any future requests of trading venues and data repositories in order to facilitate broad understanding of these critical issues in the most efficient manner possible. Thank you.
Thanks, Anne. I'll open it up to the floor for comments. Okay, we'll turn to the fourth panel of Section 3 on post-trade risk reduction. To discuss the update from the workstream, we'll turn to Guy Rowcliffe, Co-CEO and Chief Commercial Officer of Astra. Guy, please go ahead.
Thank you, Chair Crichton. Can I just check you can hear me?
We can.
Okay, great. So thank you, Chair Crichton, Commissioner Johnson and Commissioner Mercinger. I will present to you today the update of the work from the Market Structure Subcommittee on Post-Trade Risk Reduction. I know we're pushed for time, so I will attempt to just stick to the highlights for now. This is not a finalised recommendation, it's near final. We anticipate completing the work and voting on the finalised version for early January and submission following that. So some of the material I will skip over today and leave for the final submission, but going straight to the point, what we are anticipating is a recommendation for further examination on providing certain exemptions from the Commodity Exchange Act and Commission regulations to enable market participants to use post-trade risk reduction services more efficiently and optimally. So the issue we focused on is the efficient and optimal operation and usage of post-trade risk reduction services. Today's post-trade risk reduction services include compression, risk rebalancing, and risk mitigation. They optimize bilateral and cleared derivatives portfolios in order to minimize the buildup of notional amounts, trade count, basis risk, and counterparty risk, which in turn reduces overall systemic risk. These services often involve the creation of new non-price forming transactions in order to fulfill the purpose of the risk-reducing exercise. The non-price forming nature of the transactions means they are administrative and do not change the directional first-order market risk of the derivatives portfolios concerned, but rather reduce either counterparty, operational, basis, or systemic risks of the existing derivatives portfolios. Current requirements under the Commodity Exchange Act and certain US CFTC regulations can make it difficult for market participants to efficiently use certain post-trade risk reduction services or for post-trade risk reduction service solutions to be structured in the most efficient way. Under the CEA and Commission regulations, some of the resulting administrative transactions are currently subject to mandatory clearing at a derivatives clearing organization, mandatory trade execution on a swap execution facility, and real-time public reporting. As we'll explain in more detail in our submission, market participants would be able to utilize these PTRR services more efficiently and therefore reduce a greater amount of risk in their portfolios if the administrative trades generated as part of those services were exempt from the three requirements I've just mentioned. In addition, for similar reasons, we believe the Commission should also consider exempting providers of these post-trade risk reduction services from the CEF registration requirement, or at a minimum, clarify that PTRR services do not meet the trading system or platform requirement under the CEF definition in CFTC regulations when they pre-arrange transactions between multiple participants for the purpose of conducting these risk-reducing exercises. So the subcommittee recommendation is likely to be that in the view of the issues raised so far, we will recommend that the Commissioner considers adopting exemptions from the CFTC clearing obligation, from the trade execution requirement, and from real-time reporting requirements for swap transactions that are created in order to complete post-trade risk reduction services and, most importantly, meet all of the following criteria. Firstly, the exercise does not change the directional risk of covered portfolios, except for some de minimis risk for portfolio compression and second-order risks for basis risk mitigation. Secondly, participants in the exercise are not able to post bids or offers. There is no price negotiation that takes place, and transactions can be recorded away from market prices on stale curves and stale prices where applicable. Thirdly, the exercise does not allow for taking directional market positions. Fourthly, the exercise's runs or cycles take place according to pre-established schedules defined by the post-trade risk reduction providers. Next, the service provider's preset algorithm determines the overall risk reduction opportunities, nobody else. Also, the exercise is binding on an all or nothing basis across each exercise participant. And finally, the exercise is performed by a service provider independent of the participating entities. In addition, we believe the Commission should also exempt PTRR services from the CEF registration requirement, as I mentioned earlier, or at a minimum clarify that they do not meet the definition of a trading system or platform under the CEF definition in CFTC regulations. In discussing these findings, we based it on the belief that there is a need for market participants to have access to efficient risk reduction techniques, and that has been reinforced by recent market volatility and the need for participants to mitigate both counterparty risk and liquidity stress of volatile margin demands that we have seen, particularly in the last year. There are three broad types of post-trade risk reduction services. I won't go into each one, but to highlight, it's portfolio compression, portfolio rebalancing, and basis risk mitigation. In each case, the common characteristic is that those risk reduction services create new swap transactions in order to perform the respective risk-reducing exercise. These new administrative transactions, as I've mentioned, are non-price forming. They are market risk neutral and are entered into for the sole purpose of reducing portfolio risk and exposures, and therefore the exemptions we are proposing we feel appropriate. There will be more detail on each exemption in the final submission, but as I mentioned, it's the exemption from a clearing requirement, exemption from a trade execution requirement, exemption from definition of a CEF, and lastly, exemption from real-time reporting. The first three exemptions will all add to the efficiency and optimal provision and usage of those services. The last exemption from real-time reporting isn't really relevant to the efficiency of the services, but it's relevant because the administrative swap transactions that are created in order to complete those services are non-price forming events, and as a result, the requirement to publicly disseminate such swaps does not advance price transparency policy objectives, nor contribute to price discovery due to the execution on stale or stale curve or prices. Absent an exemption from all of these requirements, post-trade risk reduction service providers cannot perform the PTR exercises as efficiently as possible because they must create and use swaps that are not subject to the clearing and trading obligations in order to reduce risk and exposures. Today, post-trade risk reduction services providers use more complex products than are necessary, for example, swaptions, instead of plain vanilla IRS, and enabling post-trade risk reduction service providers to use the most efficient means to conduct risk reduction exercises would not only make the process simpler, but more importantly, lower the risk even further. So with that, I will conclude the findings of the subcommittee for now and save the rest till the full recommendation in early January.
Great. Thanks very much, Guy. I'll open the floor to MRAC members for discussion. Tyson?
Hi, thank you. I'm just going to admit that I don't fully understand post-trade risk reduction services markets, so please forgive me in advance for asking potentially very dumb questions. So you describe it as an administrative function and doesn't have any impact on price formation. Has the subcommittee determined how the participants would go about asking for the exemption? Is that by the market participants declaring this is a post-trade risk reduction service transaction and therefore it's subject to the exemption? Is it the independent service provider that would be handling this? Would they, how would the exemption requests be handled? Is it something where it's on a case-by-case basis, or it's just excluding this whole set of transactions?
It would be around the characteristics of the type of trade output as defined in those 6 or 7 points that I mentioned earlier. They are unique characteristics to the trade output from any type of these risk reduction exercises. They can be clearly identified and clearly flagged to relate them to the provision of the service, and it would be via rulemaking.
Okay, thank you.
No other questions or comments. We'll move on to our fourth section of the day, which will cover matters relevant to climate-related market risks. To begin the discussion, it's my pleasure to introduce Tamika Bent, Chief Counsel to Commissioner Kristen Johnson, an MRAC designated federal officer, as well as Kirsten Mathias, Director of Policy and Innovation for the City of London Corporation, who will share remarks. Tamika, go ahead.
Thank you. As many of you might have seen last Monday, the CFTC issued a proposed guidance regarding the listing of voluntary carbon credit derivative transactions. That guidance follows more than 2 years of CFTC engagement, examining carbon markets and the impacts of climate on financial markets. I'm going to provide you with a very brief sort of summary of the guidance. So the Commission has provided the guidance which sets out certain factors a DCM should consider when addressing requirements of the CEA and the CFTC regulations that are relevant to the contract design and listing process. Specifically, DCMs are required to comply with core principles. Core Principle 3 requires a DCM to demonstrate that listed contracts are not readily susceptible to manipulation. Core Principle 4 requires a DCM to prevent manipulation, price distortion, and disruptions of the physical delivery or cash settlement process through market surveillance, compliance, and enforcement practices and procedures. DCMs are required to submit products for listing to the CFTC either by self-certification or by seeking Commission approval. Through this process, the Commission reviews the product specifications, including information about the underlying assets, which in this case, we're talking about voluntary carbon credits. The guidance sets out a number of factors, and I'm going to give you a very brief overview. So, for example, a DCM should consider factors including transparency, additionality, permanency, and risk of reversal, as well as robust quantification in connection with the underlying VCC. Additionally, the governance framework and tracking mechanisms of the crediting program for the underlying VCCs and the crediting program's measures to prevent double counting are all additional factors a DCM should consider. Inspection or certification provisions should be specified in a DCM's contract's terms and conditions. DCMs should actively monitor the terms and conditions of VCC derivative contracts to ensure conformity with current standards and should require their market participants to keep records of their trading, including activity in the underlying spot market. Finally, a DCM is required to submit to the Commission the contract's terms and conditions and any contract amendments, and must also provide an explanation and analysis of the contract and its compliance with applicable CEA provisions. In the guidance, the Commission noted that CEFs that list swaps on VCCs should also consider the factors that are laid out in the guidance. In a supporting statement, Commissioner Johnson noted that the proposed guidance may help to improve the integrity of the VCC markets, yet there may be additional and significant areas that the proposed guidance does not address. One area that is worth noting is that there is a significant part of the environmental commodity market that trades as forwards or spots or other types of commercial contracts where commercial participants intend to take delivery of the underlying physical commodity. under the CEA, a forward on an environmental commodity that satisfies the forward exclusion to the swap definition would not be subject to the full range of the swaps regime. And so generally, those markets are not traded on an exchange. They're not cleared through a regulated clearinghouse or reported to a regulated trade repository. And there may even be intermediaries that trade in those contracts that are not required to be registered with the CFTC. And so for those markets, there may be vulnerabilities that potentially may require additional commission action to address those concerns. I think Karsten is next.
Yes, that's right. Thanks, Tamika. Now we'll hear from Kirsten.
Great. Good afternoon, everybody. And thank you very much to Commissioner Johnson and Chair Crichton for the invitation to speak here today. My name is Kirsten Matthias. I lead the City of London's Global Financial Services Policy and Innovation work, and I have been invited to provide a view from London on our sustainability priorities here today. Apologies, I cannot be with you in person. In the interest of time, I will focus on three main areas. I appreciate not all of them actually sit within areas of responsibility with the CFTC, but they do, I believe, provide some useful lessons for wider work that the CFTC might be considering. So I would like to start with the work of the ISSB and the wider lessons we can learn about the risk of misaligned approaches to sustainability standards and the need for mutual recognition mechanisms. We very much believe that 2022 was the year of disclosures, and we really welcome UK government and other government support for the development of international standards for disclosure of sustainability-related information. We also agree with the UK government that the provision of globally comparable sustainability-related information is vital for the effective functioning of capital markets. We believe that building an effective international framework for sustainability-related disclosures will avoid fragmentation and regulatory arbitrage, promote greater transparency, consistency, comparability of disclosures, and reporting costs and operational burdens. This approach, we believe, could be applied to other areas of current and future policy and regulation in sustainability. On this occasion, we believe that jurisdictional approaches, as much as possible, to sustainability information should indeed converge around the work that the ISSB has done in setting a global baseline. And this could form the basis for counterparty information required to meet sustainability disclosure requirements for international companies. We therefore consider integrating all input aspects of the ISSB standards into the UK's domestic reporting and disclosure framework to be of vital importance for the London ecosystem. We advocate for UK-US collaboration as the UK consults on the implementation of these standards and indeed enhance and strengthens dialogue between the UK and the US government and regulators and all global standard setting bodies in this space. The second issue I would like to talk about is transition planning, which has very much been a priority in this year, 2023. There's a global momentum for standards surrounding private sector transition plans and their vital role in supporting the global shift to net zero, both in the financial sector and also in the wider economy. Clarity of transition pathways will make it easier for entities to measure and assess their climate risk exposures, and it will allow banks and insurers and other actors to gather better data on counterparties' transition plans and their evolving climate exposures. This will support financial institutions to incorporate climate risk exposures into their own risk management processes. You might be familiar with the work of the UK's Transition Plan Task Force in this space. In October of this year, they released their final disclosure framework and implementation guidance for UK by UK businesses. We welcome the effort of this Transition Plan Task Force to incorporate its disclosure framework within the wider sustainability and general purpose reporting landscape. Again, another example where a national approach is looking for as much alignment as possible with the work that is happening internationally, which we applaud. The TPT framework has been designed to align with the transition planning guidance developed by the Glasgow Financial Alliance for Net Zero and to be consistent and build on the reporting standards developed by the ISSB. We believe that the UK has an opportunity here to use its first mover advantage to promote its transition planning approach to international peers. And so I'm delighted to have the ability to talk about it here to you today, because again, this might help to reduce fragmentation and increase global interoperability for entities operating in multiple jurisdictions, as those jurisdictions consider how they approach sectional addressing transition plans. We hear from firms in the UK that it may be useful to consider providing additional guidance and clarity on the application of these standards in relation to transition plans for both preparers and users of transition plan. We believe that we need to develop market tools, standards, and incentives to scale financing for credible transition of hard-to-abate sectors in particular. And we need to give confidence to capital providers that they can credibly support financing the transition without harming their own net zero or Paris-aligned targets where they exist. The UK has commissioned a transition finance market review to support the government and industry to address some of these questions. And we are delighted at the City of London Corporation to be hosting the secretariat that will support this work, and we'll be happy to discuss this work with any of the attendants in the audience today. Finally, I will conclude with a few thoughts on voluntary carbon markets, which I know has been a huge priority for Commissioner Johnson and the CFTC more generally. Carbon credits have emerged as a powerful and cost-effective mechanism which can enable immediate climate action. While they are not standalone solutions for emissions abatement, together with other decarbonization efforts, carbon credits can deliver market-led carbon pricing. Carbon credits enable responsible businesses to act today on climate action. If 1,700 of the world's highest emitting companies compensated for just 10% of their emissions through carbon market investments, more than $1 trillion of investment could be mobilized by 2030. Carbon credits get rapid climate finance to the global south on its terms today, something we urgently need to work on. We also know that companies that purchase carbon credits decarbonize twice as fast as those who do not. So we can see that the VCM has a huge role to play in supporting us to reach net zero. Despite this, carbon credits are frequently accused of allowing firms to greenwash their environmental impact. While there have been instances of scandal and misrepresentation, of course, in this market, these examples should not be used to undermine the benefits of carbon credits. To overcome reputational concerns, all elements of the carbon credit supply chain have a role to play in building a high integrity market. Over the past few years, the work of the Voluntary Carbon Markets and Integrity Initiative and the Integrity Council for the Voluntary Carbon Market have developed some standards to address these concerns and help to promote market integrity. While these are voluntary standards, we really believe that they should be the foundations to use, and any further work should build on them, including from regulators in the UK and the US and more widely. In addition to integrity, we must also look to enhance the infrastructure to support the scaling of voluntary carbon markets, such as innovative measurements, reporting and verification, technology, and a supportive legal, regulatory, and policy environment. From COP28, where I have just returned, which is now in its stages of conclusion, we hope to see progress from the negotiations on the technical aspects of Article 6, which will facilitate country-to-country trade of ITMOs, and progress here will be hugely supportive for the scaling of international markets. There are many other issues on the horizon which we would love to collaborate with the CFTC and other US stakeholders on, but in the interest of time, I will leave it here. Thank you very much.
Great, thanks so much, Kirsten. Thanks to both of you. I'll open it up to the MRAC members for discussion. Okay. We'll now begin our fifth and final section of the day on matters relevant to the Future of Finance Subcommittee. I'd like to ask Saeed Masari, co-founder and chief legal officer of Lightspark, to begin the discussion. And following Saeed's remarks, Kevin Werbach, Liam Xiao Long, First Pacific Company professor of legal studies and business ethics, and department chair at the Wharton School at the University of Pennsylvania, will provide a few remarks, followed by an open discussion on the future of finance. Please begin.
Thank you, Commissioner Johnson, Chair Crichton, and CFTC staff for asking me closer, okay, to present today. I'm Saeed Masari, a co-founder and the CLO of Lightspark, a US company building enterprise-grade payments on the Bitcoin Lightning Network. I'm also a fellow at the Berkeley Center for Business and Law at the University of California, Berkeley Law School. Before Lightspark, I was a partner in the financial institutions group at Davis Polk, with the early years of my career spent on Dodd-Frank Title VII implementation. It's nice to see many known faces from that work around the room. Our conversation today is meant to further inform the work of the Future of Finance Subcommittee. The topic, the future of finance, is ambitious, and the subcommittee's work could take many directions. Before focusing on 4 specific topics that the subcommittee could consider further, I'll make an obvious observation. It is very difficult to accurately predict the future, particularly when the future involves new technologies and the attendant implications. History is replete with examples of society misjudging the impact of a particular new technology. Examples include the internet and smartphones, each of which have changed much about our lives, for the good, mostly. But some new technologies have not and will not change the world. It can be difficult to tell apart the ones that will from the ones that won't. Part of the work of the MRAC and the subcommittee is to try to understand these developments and ensure that the CFTC is well positioned to address those that are likely to be widely adopted and to change the world, at least the world of CFTC regulated markets. I'll turn to 4 topics that, in my view, are good candidates for further exploration for the subcommittee. First, vertical integration. The CFTC and its staff have been deeply engaged on this topic for some time, and rightly so. Fundamental changes to market structure are rare, given that market structure is in effect written in stone through legislation, regulations, and supervisory structures. Accordingly, the vertical integration discussion arose first from centralized spot crypto exchanges that were regulated as payment intermediaries, not financial trading markets. To be clear, this development is not disintermediation. As the term vertical integration more correctly implies, it is a different configuration of intermediated functions. This may have benefits for markets and market participants, but it also raises different considerations for risks, conflicts of interest, and governance. As was discussed during the last MRAC meeting, many of these considerations are not in themselves new, and we have policy, regulatory, and supervisory tools to address them, informed and directed by the work already underway at the CFTC. The Future of Finance Subcommittee is well positioned to analyze and make recommendations on how existing laws and regulations could be applied to this different market structure, taking into account its benefits and risks. For example, some aspects of the market structure reduce counterparty and settlement risk because trades are pre-funded and settlement is instant. Other aspects, namely integrated custody services and conflicts of interest from the full range of services provided by crypto exchanges, brokerage, dealing, order book operations, settlement, clearing, and custody, plus other ancillary services, just as in traditional finance, need to be carefully assessed and addressed as necessary, including by applying the existing policy toolkit in this different context. Next, risk management and governance. Innovations in market structure necessarily require innovations in risk management and governance. For example, clear guidance on risk management and governance expectations for new types of services or those using new technologies would help market participants better manage risk. And it would enable regulators to recognize the role of auditors and insurance providers in risk management. Indeed, further guidance on risk frameworks and governance approaches could benefit both incumbents who need direction in how to engage in new types of activities, and also ensure new market participants operate safely. The subcommittee can play an important role in identifying areas in which this type of guidance would be useful and can help inform that guidance. Third, cyber resilience. While predicting the future is hard, It is easy to predict our increasing reliance on technology in financial services, whether for consumer or user-facing applications or core infrastructure in our financial markets. As these services evolve, so will the tactics and approaches of those trying to exploit them. The CFTC and the National Futures Association have been forward-leaning in developing standards for technological resilience for regulated intermediaries. This work is essential and should continue as new technologies are used in CFTC-regulated markets. Whether those are blockchain-based systems, smart contracts, or user-facing applications that allow the use of those technologies. Understanding new risks posed by new technologies used in CFTC-regulated markets and directing the development of new audit standards and cybersecurity resilience measures is a useful and impactful focus for the committee. Finally, decentralized or digital IDs and verified credentials. The concept of a decentralized or digital ID is a powerful one. It is a form of identification that is digitally native, a digitally issued driver's license, or some form of non-governmental ID. It is owned and controlled by the holder of the ID and can be used as a credential without needing to be separately verified and without revealing unnecessary information. The promise of this technology is one of data ownership and minimization. We need not share volumes of personal information with each one of our service providers to prove our identity or other key characteristics. We're still in the early days of DIDs and VCs. They hold great promise to improve data security and privacy, enhance interoperability and competition, and to streamline compliance processes. There, of course, is no panacea for illicit finance. But DIDs and VCs present new opportunities to combat it in ways that existing systems cannot. It will take effort on the part of issuers of these IDs, those that use them, those that accept them, and from policymakers and regulators to understand their uses, their benefits, and where they cannot address existing gaps. The subcommittee could seek to better understand the possible benefits of DIDs and VCs, the potential risks, and, if appropriate, how best to support their adoption. I look forward to any discussion we have.
Great, thanks, Ayi. Kevin?
Thank you very much for the opportunity. Given the time, I will try to be quite brief. I'm going to talk about two particular areas that I think the Future Finance Subcommittee should engage in, which are blockchain and AI, and a little bit briefly at the very end about how they might come together. There's some of the things I'll say that overlap very much with the excellent presentation you just heard from Zaid. With regard to blockchain and digital assets, we're in a very different place, of course, than we were a year and a half ago, but activity and trading continues. And with developments such as the Binance settlement, we seem to be moving towards a regulated environment for digital asset trading, and in particular, digital asset commodity trading under the oversight of the CFTC. There are two particular areas with regard to the scope of the MRAC that I think are worthy of discussion by the subcommittee. One is the mechanisms for risk management. And this is different from what Zaid was talking about in terms of risk management frameworks, although related. The digital asset industry has developed an array of sophisticated technical solutions for the various risks that have developed in the sector. In some cases, as a matter of necessity, because of the paucity of regulation, and in some cases, in order to provide the necessary trust, given the different technical and operational and business dynamics of digital asset platforms relative to traditional trading mechanisms. The Blockchain and Digital Asset Project at the Wharton School, which I led earlier this year, did a survey, found more than 30 startups that were just focused on these kinds of issues, as well as a number of larger companies. I'm talking about solutions for things like cybersecurity, fraud detection, risk analytics, smart contract audits, various kinds of custody technologies, including advanced cryptographic solutions for key management and multi-party computation, compliance solutions for things like the travel rule and KYC, detecting market manipulation, and addressing some of the distinctive risks that arise with regard to digital assets and DeFi, things like oracle risk of outside data feeds, and issues around minor extractable value and the activities of block validators with regard to the trading activity on top. All of these are relevant to understanding what the capabilities are to address the risks that are very real. I think investigation of these issues would be helpful both for the CFTC in its mission with regard to digital asset trading, but also more broadly in terms of understanding evolving regulatory technology or reg tech capabilities that may well be applicable to trading in other areas. The second category put under blockchain is what I will call technology-informed regulation. Lab CFTC has been in existence for a number of years and is a valuable asset for the agency, but its capabilities are limited. Various regulators, most notably the Bank for International Settlements and the Monetary Authority of Singapore, have developed extensive capabilities within the regulatory agency to directly engage in technology trials, technology development, in having actual computer scientists and engineers and technologists who are able to develop proofs of concepts, to engage with the industry, to identify the capabilities and potential of experimental new digital asset platforms. This may or may not go along with regulatory forbearance mechanisms such as sandboxes, but given the novelty and potential and complexity of emerging digital asset platforms and DeFi mechanisms, gaining that ability to truly understand the technology in a hands-on way would be extremely valuable. And I think it would be worth the MRAC examining what that potential would be within our area. Second broad category is AI. Obviously, this is an area of tremendous excitement right now across the board. It is not just hype. We are seeing explosive adoption of generative AI technologies on top of already very substantial adoption of other kinds of AI technologies. And it's particularly important to understand that with the growth of foundation models like GPT-4, which are platforms that can then be used by lots of different companies and individuals to build different kinds of solutions, as well as the release of open source foundation models like the Meta Llama model, the spread and implementation of generative AI is going to be much broader than just what you see from the large high-profile platforms. A survey earlier this year found that 68% of people using ChatGPT at work have not told their bosses. So the spread and adoption of these technologies is even broader than it seems. Three areas I think are worthy of consideration in the Future of Finance Subcommittee. One is with generative AI, the potential for leakage of private data through the queries. If you, for example, want to use ChatGPT or another generative AI tool to develop a trading strategy, what you are typing in goes to the company that is providing that foundation model. It might be something that they have access to, which raises various kinds of confidentiality and compliance issues, which a number of firms have been trying to address. It might be something that gets put into the training data or to the fine-tuning data that is used in the models. So a set of issues that are important to consider in terms of a new class of risks that we haven't previously seen that the generative AI technology brings to bear. The second one is simply the risks issues that come up with these AI systems being used in trading. Obviously, automated trading is not a new thing, but with AI, the possibility of automated trading bots becomes increasingly sophisticated. And we're seeing rapid development of agent-type systems that have a great deal of autonomy, that can talk to each other, plug into these foundation models and other tools, and with a tremendous amount of independence, engage in very sophisticated activities. That raises a whole series of risk issues that are poorly understood and which deserve some consideration. Third one is systemic risk. Chair Gensler at the SEC has spoken on this. Even if there is decentralization of the use of AI technologies, with these foundation models, which require massive amounts of computation that only a limited number of companies have the resources to develop, it is entirely possible that there may be seemingly independent traders and others who are using at bottom the same foundation model, which may lead to correlated and systemic risks. Again, something that is at this point a hypothetical, but one that I think deserves consideration in terms of future finance risk. And then the final one is At some point, how might these two areas of AI and blockchain come together? To the extent that one would imagine an AI-based trading bot that is operating on a DAO, a decentralized autonomous organization, where it is entirely coded through smart contracts on a blockchain, powered by digital asset transactions, difficult to have any centralized point of control for it, raises the same sorts of issues that have already come up with things like Tornado Cash, but not necessarily used for illicit purposes, but used for purposes that may still raise very serious risk issues. Again, this is not something that we are at today, but now is the time to try and think about what the potential is of that convergence of AI and blockchain, what the risks are that it raises, and how they might be addressed.
Great, thanks, Kevin, and thanks to you both. I'll open it up to the broader committee for discussion. Okay. Sorry. I'm sorry, Chip. I keep missing. Apologies.
Thank you. First of all, thanks to the CFTC and the whole team for a really excellent and thought-provoking day. This has really been tremendous. Thank you. The first part of your presentation reminded me a lot of the parallels with the foreign exchange market, especially around vertical integration and risk management. A little over 10 years ago, the FX market went through its own set of issues and came up with the FX global code that was created with input and led by the central banks around the world and major banks around the world as well, and other industry participants. And most of the industry now operates under the global code. And it consists of 6 leading principles, including ethics, governance, execution, information sharing, risk management, compliance, and settlement and confirmation. And it might be helpful to inform you of things that you might be thinking of. So if it's helpful to you, I'd be more than happy to have the FXPA arrange for the subcommittee a presentation on the FX Global Code to see if it has any value in your input. Thank you.
Great, well, we made it. So that concludes our meeting today. I'd like to express our thanks for the insights of our guest speakers, as well as the contributions from our MRAC members. Commissioner, do you have any last remarks?
Very quickly, I just want to thank everyone who's here and remained. We apologize that we're over time, but I have to, on the record, acknowledge Chair Crichton's tremendous support for the MRAC. Her participation not only in leadership here at the front, just at the dais, if you will, in terms of leading MRAC is valuable, but she's also now supporting a subcommittee and acting as a co-chair alongside Alessandro Coco and currently Chris Edmonds from ICE. And so I'd like to thank her, her co-chairs for the subcommittee for CCP risk and governance. I'd also like to thank Ann Battle and Biz Chatterjee for their leadership of the subcommittee, the market structure subcommittee. Finally, I would be remiss if I didn't say a tremendous thanks to Peter Janowski and Tamika Bent, who are here with us also at the front of the room, and my newest senior counsel, Julia Welsh, who's not with us today, but will be with us the very next MRAC meeting. I acknowledged at the outset of the meeting, and will acknowledge again, Daniel O'Connell and Parisa Nuri of the Division of Clearing and Risk, who support the subcommittees that did so much of the work for today's meeting. I also want to acknowledge the folks in IT who managed to figuratively keep the lights on, or at least keep systems flowing and working, and in particular in the context of hybrid meetings. Antonio Downing, Monet Mills, Andy Bridenkian, McBride, Venice, Raphael Constant, Margie Yates, Jean Cespedes, Pete Santos, Ty Poole, and Phyllis Campbell of my office for all of their very hard work over last week and the weekend. Thank you all so much.
Thank you, Commissioner and Chair Crichton. I want to thank everyone for attending our final MRAC meeting of 2023. The meeting is adjourned.